Welcome to a peaceful exploration of value investing, a path designed to cultivate patience and thoughtful accumulation in the world of finance. We'll gently guide you toward finding serenity in the stock market by focusing on the intrinsic worth of companies. If you find yourself drawn to these tranquil journeys, consider subscribing so you never miss a moment of calm. We'd also love to know where you're listening from tonight. Please share your location in the comments below. It's always a joy to connect with our global community. Imagine the stock market not as a frantic race, but as a vast, serene garden. In this garden, value investing is the art of tending to the most promising plants, nurturing them patiently until they reach their full, beautiful bloom. It's a philosophy inspired by wise minds like Benjamin Graham and Warren Buffett, who understood that true wealth is built not on fleeting trends but on solid foundations. At its heart, value investing is about seeing beyond the daily noise, the headlines that flicker and fade. It's about looking for businesses that are fundamentally strong, trading at prices that don't reflect their true underlying value. Think of it like finding a rare gem buried beneath ordinary stones. The market, in its natural ebb and flow, can sometimes misprice even the most brilliant of diamonds. Our task, as value investors, is to learn to recognize these overlooked treasures. This approach requires a shift in perspective. Instead of chasing quick profits or reacting to every market fluctuation, we embrace a longer view. We become detectives, meticulously researching companies, understanding their business models, their competitive advantages, and their financial health. We ask ourselves, is this a company that can endure? Does it have a durable moat, protecting it from competitors? Is its management team honest and capable? And most importantly, is it trading at a discount to its intrinsic value? Intrinsic value is the bedrock of this strategy. It's not a number that changes with the wind, but a carefully calculated estimate of a company's true worth based on its assets, earnings potential, and future prospects. When the market price of a stock falls below this calculated intrinsic value, we see an opportunity, a chance to acquire a piece of a wonderful business at a bargain. This process cultivates a unique kind of patience. It's the patience of a gardener waiting for seeds to sprout, or an artist meticulously layering paint. We understand that it can take time for the market to recognize the true value of a company. There will be periods of waiting, perhaps even periods where the stock price continues to languish. But in value investing, this waiting is not passive idleness, it's active conviction. It's a quiet confidence in the underlying strength of the business and the eventual rectification by the market. The beauty of this approach lies in its inherent calmness. By focusing on fundamentals rather than speculation, we detach ourselves from the emotional roller coaster of short-term market movements. We learn to sleep soundly, knowing that our investments are anchored in real value, not just the whims of sentiment. The stress of constant monitoring diminishes, replaced by a sense of purpose and a deeper understanding of the businesses we own. Consider the analogy of owning a piece of a well-established bakery. You know the bakery makes delicious bread, has loyal customers, and is managed by a capable team. Even if the stock price of the bakery dips for a while, your fundamental belief in its enduring value remains. You're not worried about the daily fluctuations in the price of flour. You're confident in the steady demand for good bread. This is the essence of value investing, owning a share of a sound business. As we delve deeper, we'll explore practical methods for identifying these undervalued gems. We'll touch upon key financial metrics, the importance of understanding a company's competitive landscape, and the art of assessing management quality. But remember, the underlying principle remains constant. Buy wonderful companies at fair prices, or even better, at wonderful prices. And then, hold on. Let time and the market do their work. This journey is about building a portfolio that not only grows in value over time, but also brings you a sense of peace and financial well-being. The realm of investing, much like a vast and ancient forest, holds within it timeless wisdom, passed down through generations. At the heart of one particularly enduring tradition stands Benjamin Graham, a figure often hailed as the father of value investing. His teachings, forged in the crucible of market volatility, offer a beacon of clarity for those seeking not fleeting gains but enduring prosperity. Graham's philosophy was rooted in a profound understanding of business and a deep respect for intrinsic value. He saw the stock market not as a casino, but as a marketplace where ownership stakes in real businesses were traded. His seminal works, Security Analysis and The Intelligent Investor, are not mere guides to stock picking, but philosophical treatises on how to approach the act of investing with intellect and discipline. Central to Graham's wisdom is the concept of Mr. Market. Imagine a business partner who, every single day, offers to buy or sell shares in your company at wildly fluctuating prices. Sometimes he's euphoric, offering exorbitant sums. Other times, he's deeply depressed, practically giving his shares away. Graham's insight was to recognize that Mr. Market's moods are not to be followed, but rather to be exploited. The intelligent investor, he argued, should use Mr. Market's irrationality to their advantage, buying when prices are low and selling, if ever, when they are excessively high. This requires a detachment from the daily emotional roller coaster of the market, a commitment to independent thought, and a willingness to act counterintuitively. Another cornerstone of Graham's approach is the distinction between investing and speculating. Speculation, in his view, involves betting on price movements without a thorough understanding of the underlying asset's worth. Investing, on the other hand, is the process of thorough analysis to ensure safety of principal and an adequate rate of return. This means delving into a company's financial statements, understanding its business model, assessing its competitive landscape, and evaluating its management. It is a process of due diligence, akin to a detective meticulously gathering clues before reaching a conclusion. Graham also emphasized the importance of a, quote, margin of safety. This is the difference between the intrinsic value of a security and its market price. By purchasing a stock at a significant discount to its true worth, the investor creates a buffer against unforeseen problems or analytical errors. It's like building a sturdy bridge with a much greater load-bearing capacity than is strictly necessary. This margin of safety provides protection during market downturns and enhances the potential for capital appreciation as the market eventually recognizes the company's true value. These principles, though laid down decades ago, resonate with remarkable power today. They found a most devoted and successful disciple in Warren Buffett, who readily acknowledges Graham as his mentor. Buffett, in turn, has eloquently articulated and applied these concepts, demonstrating their enduring relevance. His approach, characterized by patience, a deep understanding of business economics, and an unwavering focus on long-term value, is a testament to the timelessness of Graham's foundational ideas. The wisdom of these masters reminds us that successful investing is not about predicting the future or chasing the latest trends. It is about understanding value, exercising patience, and maintaining a rational perspective amidst the often frenzied activity of financial markets. It is a journey of continuous learning, diligent analysis, and a disciplined adherence to principles that have proven their worth through the passage of time. By embracing this mindset, one can cultivate a more thoughtful and rewarding approach to building wealth, one grounded in the solid bedrock of intrinsic value and long-term vision. The relentless dance of stock prices, a daily spectacle of gains and losses, can often distract from the fundamental truth of a company. While the ticker symbol flashes and fluctuates, its true worth lies not in these transient movements but in the enduring substance of the business itself. This deeper value, often referred to as intrinsic value, represents the underlying economic reality of an enterprise. Imagine a seasoned craftsman, his hands weathered by years of dedicated work, meticulously shaping wood into a timeless piece of furniture. The market might offer a fleeting price for his creation each day, influenced by trends and speculation. Yet, the true worth of that furniture is not merely its current selling price. It is in the quality of the materials, the skill of the artisan, the enduring design, and the generations it may serve. Similarly, a company's intrinsic value is built upon its tangible assets, its intellectual property, its customer base, its management team, and its ability to generate profits over the long haul. To understand intrinsic value is to look beyond the ephemeral headlines and quarterly reports that often dominate financial news. It is to engage in a thoughtful examination of the business itself. This involves understanding its industry, its competitive advantages, its financial health, and its future prospects. It is a process that requires patience, a willingness to delve into the details, and a perspective that extends far beyond the immediate horizon. Benjamin Graham, the father of value investing, championed this approach. He taught that the market, in its short-term focus, can often misprice assets, creating opportunities for the discerning investor. Sometimes, the market's perception of a company's worth can diverge significantly from its intrinsic value. This divergence is where the potential for significant returns lies. When a company's stock price falls below its intrinsic value, it presents an opportunity to acquire a piece of a sound business at a discount. Warren Buffett, Graham's most famous protege, has eloquently illustrated this principle. He often speaks of buying businesses, not just stocks. This mindset shift is crucial. Instead of viewing an investment as a mere ticker symbol to be traded, it becomes an ownership stake in a real, operating entity. This ownership stake entitles one to a share of the company's future earnings and growth. The journey to identifying intrinsic value is not a sprint, but a marathon. It requires a disciplined approach, a commitment to research, and a healthy dose of skepticism towards market noise. It involves studying financial statements, understanding the economics of the business, and assessing the quality of its management. It is about recognizing that a company's true worth is not dictated by the daily whims of the stock market, but by its fundamental ability to create value for its stakeholders. Patience is a cornerstone of this philosophy. The market does not always correct its mispricings immediately. There may be periods where a stock remains undervalued. During these times, it is essential to hold firm to one's assessment of intrinsic value and resist the urge to panic or chase fleeting trends. The true reward of value investing comes from the long-term compounding of wealth, as undervalued companies eventually see their stock prices converge with their true worth. By focusing on intrinsic value, investors can cultivate a more stable and less stressful approach to the markets. This perspective shifts the emphasis from trying to predict short-term price movements to understanding the enduring quality of a business. It fosters a sense of ownership and a deeper connection to the companies in which one invests. Ultimately, it is about building a portfolio that is not only financially sound but also grounded in a clear understanding of the underlying substance of the businesses that drive our economy. This thoughtful approach allows for a more serene and confident journey through the world of investing. The pursuit of sound investment begins with a profound understanding of value. This is not a fleeting trend or a speculative guess, but a deep, reasoned assessment of a company's intrinsic worth. It is the bedrock upon which a stable and enduring investment journey is built, a crucial step in moving beyond the often turbulent currents of emotional decision-making. To truly grasp a company's value, one must look beyond the daily fluctuations of the stock market. The true worth of a business is an intrinsic quality, a reflection of its assets, its earnings power, its future prospects, and its management's competence. This is the domain of fundamental analysis, a methodical examination that seeks to uncover what a company is truly worth, independent of its current market price. It is about understanding the engine that drives the business, the tangible and intangible assets that contribute to its ongoing success. Consider the balance sheet, a snapshot of a company's financial health. It reveals what a company owns, its assets, and what it owes, its liabilities. The difference, the equity, represents the ownership stake. But value extends far beyond mere accounting. It encompasses the company's ability to generate profits, its revenue streams, its cost management, and its operational efficiency. These are the engines of wealth creation, the factors that determine a business's long-term viability and its capacity to reward its owners. Earnings power is a particularly vital component. A company that consistently generates strong profits, year after year, possesses a fundamental strength that is often overlooked in the frenzy of market speculation. Analyzing historical earnings, understanding the trends, and projecting future performance are all essential elements in assessing this crucial aspect of value. It is the consistent generation of profit that allows a company to reinvest in its operations, to innovate, to expand, and ultimately, to grow its intrinsic worth. Furthermore, the future prospects of a company play a significant role. What are the industry trends? Is the company in a growing sector or one facing obsolescence? Does it possess a competitive advantage, a moat, as some investors describe it, that will protect its market share and profitability from competitors? These forward-looking considerations are not about predicting the future with certainty, but about making informed judgments based on available information and a rational assessment of probabilities. The quality of management is another indispensable factor. A skilled and ethical management team is essential for navigating the complexities of business, for making sound strategic decisions, and for allocating capital effectively. Investors often seek out companies led by individuals who demonstrate integrity, foresight, and a commitment to long-term shareholder value. Their ability to adapt to changing circumstances and to seize new opportunities can be a powerful driver of a company's enduring success. By diligently evaluating these elements, an investor can arrive at an estimate of a company's intrinsic value. This is the number that represents the true worth of the business, the anchor that will guide investment decisions. When the market price of a company's stock falls significantly below this estimated intrinsic value, it presents an opportunity. This gap between price and value is the margin of safety, the buffer that protects against unforeseen setbacks and allows for the possibility of a favorable outcome. This disciplined approach to identifying undervalued companies provides a stable foundation for any investment portfolio. It encourages patience, a willingness to wait for the right opportunity, and a resistance to the urge to chase fleeting market fads. It is a journey of understanding, of careful analysis, and of unwavering focus on the long-term potential of the businesses being invested in. This thoughtful exploration of value transforms investing from a speculative gamble into a deliberate and rewarding pursuit. Investing at its core is about acquiring assets. But not just any assets. The most prudent approach involves a deep understanding of value, and more importantly, a deliberate strategy to purchase that value at a discount. This principle, often referred to as the margin of safety, is not merely a suggestion. It is a cornerstone of sound investing, a vital buffer against the inherent uncertainties of the financial world. Imagine a bridge. Engineers design bridges to withstand far more weight than they are ever expected to carry. This excess capacity is their margin of safety, ensuring that even with unexpected loads, imperfections in materials, or unforeseen stresses, the bridge remains stable and secure. In the realm of investing, the margin of safety operates on a similar, yet more fluid, principle. It is the practice of buying an asset, be it a stock, a bond, or any other investment, for a price significantly below its estimated intrinsic value. Intrinsic value itself is not a fixed, easily quantifiable number. It is an estimation, a projection based on a company's current performance, its future prospects, its assets, its liabilities, and the broader economic landscape. Because this estimation is inherently subjective and prone to error, a margin of safety becomes indispensable. It provides a cushion, a protective layer that absorbs potential inaccuracies in valuation, unexpected economic downturns, or company-specific challenges. Consider a company whose intrinsic value is estimated to be $100 per share. A disciplined investor, employing the margin of safety, would not purchase this stock at $100. Instead, they might wait for the market price to fall to $60 or $70 or even lower. This $30 to $40 difference represents the margin of safety. It is the room for error, the protection against unforeseen events that could diminish the company's future earnings or overall worth. This principle demands patience. The market does not always provide opportunities to buy good companies at deeply discounted prices. There will be periods when quality assets trade at or even above their estimated intrinsic value. During these times, the disciplined investor understands the value of waiting. They recognize that forcing an investment when no margin of safety exists is akin to crossing a bridge without that vital engineering buffer. It is a gamble, not an investment. The margin of safety also fosters a more rational and less emotional approach to investing. When an investment is made with a significant discount, the investor is less likely to panic during market volatility. The initial purchase price provides a sense of security, knowing that the asset was acquired at a bargain. This psychological advantage helps to maintain discipline during turbulent times, preventing impulsive decisions driven by fear or greed. Furthermore, a margin of safety amplifies the potential for favorable returns. When an asset is purchased at a substantial discount, even a modest increase in its intrinsic value or a return to its true worth can lead to significant gains. The wider the margin of safety at the time of purchase, the greater the potential upside when the market eventually recognizes the asset's true value. The concept of intrinsic value and the margin of safety are deeply intertwined with the philosophy of value investing, famously championed by figures like Benjamin Graham and Warren Buffett. Graham, often called the father of value investing, emphasized the importance of treating stocks not as speculative bets, but as ownership stakes in businesses. He advocated for a rigorous analysis of a company's financial health, its competitive advantages, and its management quality to arrive at an estimate of intrinsic value. Buffett, a student and admirer of Graham, has consistently applied and refined these principles throughout his remarkable career. He often speaks of buying wonderful companies at fair prices, or fair companies at wonderful prices. The underlying theme remains the same: acquire assets for less than they are worth. This disciplined approach, grounded in a deep understanding of business fundamentals and a commitment to patience, is what allows for the creation of enduring wealth. The margin of safety is not just a numerical calculation. It is a mindset, a commitment to prudence, and a recognition that the path to long-term investment success is built on a foundation of careful analysis and a healthy dose of caution. In the realm of prudent investing, building resilience into a portfolio is not merely a strategy. It is a fundamental pillar of long-term success. This resilience is often achieved through the principle of a generous margin of safety. It is the cornerstone that allows for the minimization of risk while simultaneously enhancing the probability of achieving positive returns. Imagine an investor approaching the market not with haste, then with deliberate consideration. The margin of safety is akin to purchasing a valuable asset for significantly less than its intrinsic worth. This deliberate act of securing a bargain provides a crucial buffer against unforeseen circumstances, market downturns, unexpected economic shifts, or company-specific challenges, all of which are inherent to the investment landscape. can be weathered more effectively when an investment has been acquired at a discounted price. This approach fosters a profound sense of peace of mind. It is the quiet confidence that arises from knowing a sound decision was made, a good deal was secured. This is not about chasing speculative gains or succumbing to market fads. Instead, it is about a patient, methodical assessment of value. It involves deep analysis, understanding the underlying business, its competitive advantages, its management, and its long-term prospects. When a company's intrinsic value is meticulously calculated and its market price falls substantially below that assessment, a margin of safety is created. This gap between perceived value and actual cost acts as a protective cushion. If the assessment of intrinsic value proves to be slightly optimistic, or if external factors negatively impact the company's performance, the margin of safety absorbs much of this negative impact, preventing significant capital loss. Conversely, if the intrinsic value is accurately assessed or even underestimated, the margin of safety amplifies the potential for substantial gains as the market eventually recognizes the true worth of the enterprise. The concept is elegantly simple yet profoundly powerful. It is rooted in the wisdom of experienced investors who understand that the market can be irrational in the short term. Prices can deviate significantly from underlying value, presenting opportunities for those who possess the patience and foresight to identify them. The margin of safety is the investor's shield against this short-term volatility, allowing them to focus on the long-term trajectory of the business. Building this resilience is a continuous process. It requires ongoing vigilance and a commitment to disciplined investing. It means resisting the temptation to overpay for growth, even when a company exhibits impressive momentum. It means being willing to wait for the right opportunity, for the market to offer a stock at a price that reflects a significant discount to its fundamental worth. This patient accumulation of undervalued assets, secured with a margin of safety, creates a portfolio that is not only robust, but also possesses a higher likelihood of delivering consistent, positive returns over time. It is an approach that prioritizes capital preservation and steady growth, fostering financial security and peace of mind. The margin of safety, therefore, is more than just a numerical discount. It is an embodiment of thoughtful investing, a commitment to enduring value, and a pathway to building a truly resilient financial future. It is about buying with conviction, knowing that the price paid provides a substantial buffer, allowing for the inevitable ups and downs of the market to be navigated with a steady hand and a tranquil spirit. Benjamin Graham, the father of value investing, offered a framework for discerning truly sound businesses. His approach was not about chasing fleeting trends, but about a deep, methodical analysis, a patient examination of a company's intrinsic worth. This methodical approach forms the bedrock of the intelligent investor's checklist. At its core, this checklist involves scrutinizing a company's financial health. Graham emphasized looking beyond the surface, beyond the daily fluctuations of the stock market, to understand the underlying substance of the enterprise. This means delving into financial statements, not with a hurried glance, but with a thoughtful consideration of the numbers. Key financial metrics serve as vital signposts. Consider the concept of earnings. A consistent, growing stream of earnings is a fundamental indicator of a healthy business. Graham advised looking for companies with a solid track record, not just a single good year, but a sustained ability to generate profits over time. This consistency speaks to the resilience and predictability of the business model. Profitability ratios, such as the return on equity, offer further insight. This metric reveals how effectively a company is using its shareholders' investments to generate profits. A strong and stable return on equity suggests a well-managed business that is adept at creating value. Similarly, profit margins, both gross and net, indicate the company's efficiency in managing its costs and converting revenue into profit. Healthy margins, when compared to industry peers, can signal a competitive advantage. Beyond profitability, liquidity is crucial. A company must be able to meet its short-term obligations. Ratios like the current ratio and the quick ratio provide a snapshot of a company's ability to do so. A comfortable level of liquidity ensures that the business is not teetering on the edge of financial distress, a vital element for long-term stability. Debt levels are another critical area of examination. While some debt can be a tool for growth, excessive leverage can be a significant risk. Graham favored companies with conservative debt-to-equity ratios, indicating a financial structure that is less vulnerable to economic downturns. A company burdened by too much debt faces a higher risk of default, impacting its long-term viability. However, Graham's analysis extended beyond mere numbers. He understood that a company's financial strength is intrinsically linked to its qualitative characteristics. These are the less tangible, yet equally important, factors that contribute to a business's enduring success. One such factor is the quality of management. Are the leaders of the company honest, competent, and acting in the best interests of shareholders? A strong management team can navigate challenges, innovate, and guide the company towards sustained growth. Graham advocated for investing in businesses run by ethical and capable individuals, recognizing that good leadership is a powerful asset. Competitive advantage, often referred to as a moat, is another crucial qualitative element. Does the company possess something that protects it from competitors? This could be a strong brand, proprietary technology, efficient scale, or unique patents. A durable competitive advantage allows a company to maintain its profitability and market share over the long term, shielding it from intense rivalry. The industry in which the company operates also warrants careful consideration. Is it a growing industry with favorable long-term prospects, or one facing obsolescence? Investing in companies within robust and expanding sectors offers a greater probability of success. Graham was not interested in businesses destined for decline, but rather those positioned to thrive in the future. Finally, Graham emphasized the importance of a margin of safety. This is the difference between a company's intrinsic value and its market price. By purchasing a stock at a price significantly below its estimated true worth, an investor creates a buffer against unforeseen negative events or errors in valuation. This margin of safety is not merely a tactic, but a fundamental principle that safeguards capital and enhances the probability of achieving positive returns. It is the intelligent investor's ultimate defense. This methodical, dual-pronged approach, analyzing both the quantitative and qualitative aspects, forms the essence of Graham's enduring wisdom. The bedrock of astute investment lies in a steadfast focus on the tangible, not the fleeting trends or the speculative whispers, but the concrete realities that define a business's true worth. This is where the disciplined investor begins, by grounding their analysis in the fundamental elements that represent enduring value. Consider first the company's assets. These are the physical and financial possessions that the business owns, the machinery that produces goods, the real estate that houses operations, the inventory ready for sale, and the cash reserves that provide stability. A thorough understanding of these assets allows for an assessment of the company's intrinsic worth, a baseline against which its market price can be measured. It is about seeing the substance beneath the surface, the tangible foundation upon which future prosperity is built. Equally crucial is the assessment of a company's earnings power. This refers to its consistent ability to generate profits. A business that reliably produces strong earnings, year after year, demonstrates a fundamental strength that is often overlooked in the clamor for rapid growth. Analyzing historical earnings, Understanding the drivers of profitability and projecting future earning potential requires careful examination. It is a testament to the company's operational efficiency, its market position, and its management's effectiveness. This sustained ability to earn is a powerful indicator of a sound investment. And then there are dividends. For many value investors, dividends represent a tangible return on investment, a direct share of the company's profits distributed to its owners. Companies that consistently pay and ideally grow their dividends often signal financial health and a commitment to returning value to shareholders. This is not merely a passive income stream. It is a reflection of a mature, profitable business capable of sustaining its operations while rewarding its investors. The presence of a healthy dividend can be a comforting sign, a concrete benefit that accrues over time. By prioritizing these tangible aspects, assets, earnings power, and dividends, the investor cultivates a powerful analytical rigor. This disciplined approach acts as a filter, sifting through the noise of the market to reveal opportunities that are genuinely undervalued. It is about identifying businesses whose intrinsic worth is not fully recognized by the broader market, offering the potential for long-term capital appreciation as that value is eventually acknowledged. This focus on fundamentals fosters a sense of patience. The true value investor understands that market fluctuations are a natural part of the investment landscape. Rather than being swayed by short-term volatility, they remain steadfast, confident in the underlying strength of their chosen businesses. They are not seeking quick wins, but rather a steady, compounding growth of their capital over extended periods. This long-term perspective is essential, allowing the power of compounding to work its magic and for the market to eventually reflect the true, intrinsic value of the underlying enterprises. The process of identifying these undervalued opportunities is not about predicting the future with certainty, but about making informed decisions based on sound principles. It involves diligent research, a thorough understanding of financial statements, and an appreciation for the business's competitive advantages. It is an intellectual pursuit, demanding patience and a willingness to think independently, to look beyond the prevailing sentiment and to trust in the enduring power of fundamental value. This methodical approach, rooted in tangible realities, provides a stable anchor in the often turbulent seas of the financial markets, guiding the investor towards a more secure and prosperous future. Benjamin Graham, the father of value investing, laid the foundational principles for a generation of investors. His approach was rigorous, emphasizing the intrinsic value of a company and the importance of a significant margin of safety. Graham taught that an investment's true worth lay not in fluctuating market prices, but in its underlying assets, earnings power, and financial health. He advocated for buying stocks that were demonstrably cheaper than their liquidation value, often referred to as cigar butt investing, finding a stock with one last puff of value. Warren Buffett, a student of Graham, absorbed these lessons deeply. For years, Buffett meticulously applied Graham's quantitative methods, scrutinizing balance sheets and income statements with a keen eye for statistical bargains. His early investment decisions reflected this strict adherence to Graham's philosophy, seeking out companies that were overlooked by the market but possessed solid fundamentals. However, as Buffett's own investment journey unfolded, a subtle yet profound evolution began to take shape. While the core principles of value remained paramount, his focus broadened. He started to recognize that simply buying cheap was not always the most sustainable path to long-term wealth. The cigar butt approach, while effective in certain scenarios, often involved companies with limited future prospects. This led Buffett to a crucial realization. The true magic of investing lay not just in buying cheap, but in buying wonderful businesses at fair prices. He began to shift his attention towards companies with enduring competitive advantages, what he famously termed moats. These moats, like a castle's protective ditch, shield a business from competitors, allowing it to maintain profitability and market share over extended periods. Consider companies with strong brand recognition, patented technologies, or economies of scale that make it difficult for rivals to compete. These are the types of businesses that, even if not dirt cheap, offered a higher probability of sustained growth and returns. Buffett learned that a slightly more expensive but superior business could ultimately generate far greater value than a cheap but mediocre one. This refined philosophy, often described as wonderful businesses at fair prices, marked a significant departure from Graham's more purely quantitative approach. It incorporated qualitative factors, the strength of management, the durability of the business model, and the predictability of future earnings. Buffett understood that these elements, combined with a disciplined approach to valuation, were the keys to compounding wealth over decades. The transition was not an overnight event, but a gradual process of learning and adaptation. Buffett himself has acknowledged Graham's immense influence, but also credited his business partner, Charlie Munger, with helping him to see the importance of quality. Munger encouraged Buffett to look beyond mere statistical cheapness and instead focus on businesses with exceptional long-term potential. This evolution reflects a deeper understanding of what creates lasting value. It's about identifying companies that can consistently generate strong returns on capital, reinvest their earnings wisely, and withstand the inevitable challenges and disruptions that arise in the business world. It's about patience, a willingness to wait for the right opportunities, and a commitment to understanding the businesses one invests in. The principles of value investing, as espoused by Graham and refined by Buffett, offer a timeless framework for building wealth. By understanding the intrinsic worth of a business, seeking a margin of safety, and increasingly, by focusing on the enduring quality of wonderful businesses, investors can navigate the complexities of the market with a steady hand. This patient, disciplined approach, rooted in sound financial principles and a forward-looking perspective, holds the promise of significant long-term rewards, fostering a sense of calm and confidence in the pursuit of financial well-being. The concept of a moat is central to understanding Warren Buffett's investment philosophy. It refers to a durable competitive advantage that protects a company's profitability from rivals, much like a medieval castle's moat protected it from invaders. These moats are not fleeting advantages. They are deep-rooted strengths that allow a business to maintain its market position and, crucially, its earnings power over extended periods. Identifying these moats requires a careful examination of a company's underlying business. One of the most significant moats is a strong brand name. Companies with beloved and trusted brands can often command premium prices for their products or services. Consumers are willing to pay more for the perceived quality, reliability, or status associated with that brand, creating a barrier for competitors who lack such recognition. Think of iconic brands that have stood the test of time, their names synonymous with excellence in their respective industries. Another powerful moat is a cost advantage. This can arise from various factors, such as superior technology, proprietary processes, or economies of scale that allow a company to produce goods or services at a lower cost than its competitors. This cost advantage enables the company to either offer lower prices and gain market share, or maintain competitive pricing while enjoying higher profit margins. It's a difficult advantage for rivals to replicate, especially if it's built on years of investment and operational efficiency. Network effects can also create a formidable moat. This occurs when the value of a product or service increases as more people use it. Social media platforms, for example, become more valuable to each user as more of their friends and connections join. Similarly, marketplaces thrive when a critical mass of both buyers and sellers is present. Once a network effect takes hold, it becomes incredibly difficult for new entrants to challenge the established player. Intellectual property, such as patents and copyrights, can also serve as a moat, particularly in industries like pharmaceuticals or technology. These legal protections grant exclusive rights to an invention or creation for a specific period. preventing others from capitalizing on it. This allows companies to recoup their research and development investments and generate significant profits without direct competition. Finally, regulatory advantages, though sometimes controversial, can also act as a moat. In certain industries, licenses, permits, or government regulations can create high barriers to entry, effectively limiting competition and protecting incumbent firms. Beyond identifying the moat itself, a key aspect of value investing is recognizing businesses with consistent and predictable earnings power. This predictability is a direct consequence of a strong moat. Companies that can reliably generate profits year after year, with minimal volatility, are highly desirable. Their earnings are not subject to wild swings based on fads or short-term market conditions. Instead, they exhibit a steady upward trend, reflecting the enduring strength of their competitive advantage. Predictable earnings allow investors to better forecast future cash flows, which is essential for determining a company's intrinsic value. When earnings are stable and growing, it provides a solid foundation for long-term investment returns. It suggests that the business is well managed, has a resilient business model, and is capable of navigating economic cycles. This predictability also fosters a sense of security and confidence for the long-term investor, reducing the anxiety often associated with market fluctuations. The pursuit of companies with strong moats and predictable earnings is a cornerstone of a patient, long-term investment strategy. It's about finding businesses that are built to last, protected by inherent advantages, and capable of delivering consistent financial results. This focus on quality and durability forms the bedrock of enduring wealth creation. The pursuit of hidden gems, those companies trading below their intrinsic worth, is a cornerstone of patient investing. It requires a deliberate approach, a willingness to look beyond the fleeting headlines and the daily market fluctuations. This is not a race, but a journey of careful observation and diligent research, a path that rewards those who understand that true value often lies just beneath the surface, waiting to be discovered. Finding these undervalued opportunities begins with a fundamental understanding of what a company is truly worth. This intrinsic value is not an arbitrary number, but a carefully calculated assessment of a business's assets, its earnings power, its future prospects, and its competitive advantages. It is a deep dive into the very fabric of the enterprise, separating the substance from the speculative froth. One practical method for uncovering these gems involves a keen eye for stability and predictability. Businesses with a long history of consistent earnings, even if their growth is modest, can often be overlooked by a market captivated by rapid expansion. These are the companies that have weathered economic storms, demonstrating resilience and a proven business model. Their stability can be a sign of underlying strength, a quiet confidence that often translates into long-term value. Another avenue of exploration lies in identifying companies that are temporarily out of favor. Market sentiment can be a powerful yet often irrational force. A negative news event, a sector-wide downturn, or even a change in management can cause the stock price of an otherwise sound company to fall below its true worth. For the patient investor, these moments of temporary distress can present significant opportunities. It's about understanding that the market's short-term reactions do not always reflect the company's long-term potential. The concept of a margin of safety is paramount in this search. This is the buffer zone between the price paid for a stock and its estimated intrinsic value. It is a crucial protection against unforeseen events and the inherent uncertainties of business. By purchasing a stock at a significant discount to its intrinsic value, an investor creates a cushion that can absorb potential miscalculations or market volatility, thereby safeguarding capital and enhancing the probability of a positive outcome. Diligent research is the engine that drives this process. It involves more than just glancing at financial statements. It demands a deep understanding of the business itself. What does the company do? How does it make money? Who are its competitors? What are the risks and opportunities it faces? Answering these questions requires a commitment to thorough investigation, a willingness to spend time understanding the nuances of each potential investment. Quantitative analysis plays a vital role, examining metrics such as price-to-earnings ratios, price-to-book ratios, dividend yields, and debt levels. However, qualitative factors are equally important. The quality of management, the strength of the brand, the competitive landscape, and the long-term industry trends all contribute to a company's intrinsic value and its future prospects. Patience is not merely a virtue in value investing. It is a prerequisite. The market does not always recognize true value immediately. It can take time for the underlying strength of a company to be reflected in its stock price. The patient investor understands this and is willing to hold on to their investments, allowing the intrinsic value to be realized over time. This long-term perspective is what separates the successful value investor from the short-term speculator. The search for hidden gems is a discipline that rewards thoughtfulness, perseverance, and a deep understanding of business fundamentals. It is a process of uncovering overlooked opportunities, investing with a margin of safety, and allowing time and the market's eventual recognition of true worth to generate returns. It is a quiet pursuit, a testament to the enduring power of fundamental analysis and the wisdom of patient accumulation. Understanding a company's intrinsic worth requires a careful examination of its financial health. This process involves looking beyond the surface and delving into the numbers that truly tell a story. Among the most fundamental tools for this analysis are common valuation metrics, each offering a unique perspective on a company's market price relative to its underlying value. One widely observed metric is the price-to-earnings ratio, often abbreviated as PE. This ratio is calculated by dividing a company's current share price by its earnings per share. It essentially tells us how much investors are willing to pay for each dollar of a company's earnings. A high PE ratio might suggest that investors expect strong future growth, or it could indicate that a stock is overvalued. Conversely, a low PE ratio could signal that a company is undervalued, or it might reflect concerns about its future prospects. When considering the PE ratio, it is crucial to compare it with industry averages and the company's historical PE multiples. A PE that is significantly lower than its peers or its own past performance, without apparent fundamental reasons, can be an initial flag for potential undervaluation. Another important metric is the price-to-book ratio, or PB ratio. This is determined by dividing a company's market capitalization by its book value. Book value represents the company's net asset value, its assets minus its liabilities, as reported on its balance sheet. The PB ratio, therefore, indicates how much investors are paying for each dollar of a company's net assets. A PB ratio below 1 suggests that the market values the company at less than its net asset value, which can be a compelling sign of undervaluation, especially for companies with tangible assets like real estate or manufacturing facilities. However, it is important to remember that book value may not always reflect the true market value of a company's assets, particularly for businesses with significant intangible assets like brand recognition or intellectual property. The dividend yield also provides valuable insights into a company's valuation and its commitment to returning value to shareholders. Dividend yield is calculated by dividing the annual dividend per share by the current share price. It represents the percentage return an investor receives in the form of dividends. A higher dividend yield can be attractive, suggesting a company is generating sufficient profits to distribute to its owners. When a company with a history of stable or growing dividends offers a significantly higher yield than usual, it might be an indication that its stock price has fallen, potentially below its intrinsic value. This can be particularly true if the underlying business remains sound and the dividend payments are sustainable. However, it is essential to investigate why the yield has increased A rising dividend yield could also be a warning sign if it is due to a rapidly falling stock price, signaling underlying business problems or an unsustainable dividend. These metrics are not standalone indicators but rather pieces of a larger puzzle. They are most effective when used in conjunction with a thorough qualitative analysis of the business itself. A deep understanding of the company's competitive advantages, management quality, industry trends, and overall economic environment is paramount. Valuation metrics are tools to guide further inquiry, to identify potential opportunities that warrant deeper investigation. Patience is a virtue in value investing, allowing time for the market to recognize the true worth of well-chosen companies. By thoughtfully applying these common valuation metrics, alongside a commitment to diligent research, one can begin to discern the subtle signals of undervaluation, paving the way for a more robust and enduring investment journey. The bedrock of any enduring enterprise lies not merely in its products or services, but in the quality and integrity of its leadership. Competent management, guided by unwavering ethical principles, forms a vital, though often underestimated, asset. This unseen force shapes the very trajectory of a company, influencing its ability to navigate challenges, seize opportunities, and ultimately deliver sustainable value over time. When assessing a business, the character of its stewards is paramount. Are they driven by a genuine desire to build long-term prosperity, or are they susceptible to the allure of short-term gains at the expense of future stability? Ethical leadership fosters a culture of transparency and accountability, building trust not only among employees and customers, but also with the investment community. This trust is a currency that appreciates over time, attracting capital and talent, and creating a resilient organization less prone to the vagaries of market fluctuations. The signs of strong management are often subtle, revealed through consistent decision-making, a clear strategic vision, and a demonstrated commitment to stakeholder interests. It is evident in how leaders communicate, how they allocate resources, and how they respond to adversity. A management team that prioritizes prudent financial stewardship, invests wisely in research and development, and cultivates a loyal workforce is laying the groundwork for enduring success. They understand that true value creation is a marathon, not a sprint, requiring patience, discipline, and a long-term perspective. Conversely, a lack of integrity or competence at the helm can be a significant red flag. When leadership is characterized by opacity, excessive risk-taking, or a disregard for ethical conduct, the long-term viability of the business is called into question. Such practices may yield ephemeral profits, but they often erode the fundamental strength of the company, leaving it vulnerable to future downturns and reputational damage. The pursuit of quick wins can lead to decisions that are detrimental in the long run, sacrificing sustainable growth for immediate gratification. Therefore, a thorough examination of management quality and integrity is an indispensable component of a value-oriented investment approach. It requires looking beyond the superficial metrics and delving into the character and capabilities of the individuals guiding the ship. This involves understanding their track record, their compensation structures, and their alignment with the interests of all shareholders. A management team that is transparent about its challenges and proactive in addressing them, while consistently executing on its strategic objectives, offers a reassuring signal of competence and trustworthiness. The patient investor recognizes that identifying such leadership is a crucial step in uncovering businesses with the potential for sustained growth and capital appreciation. It is an investment in the people who will be responsible for steering the company through evolving market landscapes. The integrity of management acts as a protective shield, safeguarding the company's assets and reputation, and fostering an environment where innovation and responsible growth can flourish. This commitment to ethical governance, coupled with strategic acumen, forms the invisible foundation upon which lasting value is built. It is a testament to the principle that good governance is not merely a regulatory requirement, but a fundamental driver of long-term corporate success. The enduring strength of a company, in essence, is a reflection of the character and foresight of its leaders. The foundation of any enduring enterprise lies within its business model. This is the fundamental blueprint, the essence of how a company creates, delivers, and captures value. A clear, comprehensible business model is not merely an organizational chart. It is the engine that drives consistent performance and fosters resilience, particularly in the face of economic shifts. Consider a company that sells a product or service directly to consumers. Its business model might be elegantly simple. Acquire raw materials, transform them through manufacturing, market the finished goods, and distribute them to customers. The revenue generated from these sales, after accounting for the costs of production, marketing, and distribution, represents the profit. This profit, when sustained and growing, is what translates into long-term value for shareholders. The beauty of a straightforward business model lies in its predictability. When the mechanics of how a company earns its money are easy to grasp, it becomes easier to forecast future performance. This clarity allows for a more confident assessment of a company's intrinsic worth, a cornerstone of value investing. An understandable model reduces ambiguity, allowing for a more focused analysis of its strengths, its competitive advantages, and its potential for future growth. Think of businesses that have stood the test of time. Many of them operate on principles that are remarkably consistent. A utility company, for instance, provides an essential service: electricity, water, or gas. Its business model relies on the steady demand for these services, often protected by regulatory frameworks that ensure a stable revenue stream. While capital expenditures are significant, the recurring nature of customer payments creates a predictable cash flow, making its long-term prospects easier to evaluate. Similarly, a well-established consumer staple company, producing everyday items that people need regardless of economic conditions, often possesses a robust business model. Their products, from toothpaste to canned goods, are in constant demand. The company's ability to efficiently produce and distribute these goods, coupled with strong brand recognition, allows it to maintain market share and generate consistent profits. This predictability is a valuable asset in the eyes of a prudent investor. The resilience of a company is often directly correlated with the strength and simplicity of its business model. Businesses that rely on a single, highly cyclical product or service, or those with overly complex and opaque operational structures, can be more vulnerable to market fluctuations. In contrast, a company with a diversified revenue stream, a clear value proposition, and efficient operations built upon an understandable model is better positioned to weather economic storms. When examining a company, a key question to ask is, how does this company make its money? The answer, if it can be articulated clearly and concisely, is a significant indicator of its potential for long-term success. It speaks to the core competency of the enterprise, its ability to solve a problem or fulfill a need in a way that customers are willing to pay for. This understanding is not about complex financial jargon or intricate algorithms. It is about discerning the fundamental logic of a business. A company that sells software, for example, might have a subscription-based model, generating recurring revenue from ongoing service fees. This model offers a degree of predictability absent in businesses that rely on one-time sales. The clarity of this recurring revenue stream makes it easier to assess the company's financial health and future earning potential. The pursuit of value investing is, in many ways, a journey of seeking out these well-understood, resilient businesses. It is about patience and a deep appreciation for fundamentals. By focusing on companies with clear, sustainable business models, investors can build portfolios that are not only sound, but also possess the potential for steady, long-term growth. offering a sense of security and peace of mind. The simplicity of a strong business model often translates into the predictability of its financial outcomes, a comforting prospect for those who invest for the long haul. The realm of investing, much like life itself, is often a dance between rational decision-making and the subtle yet powerful currents of human emotion. Among these, two primal forces stand out as particularly potent in their ability to sway the course of even the most meticulously crafted investment strategies: fear and greed. Fear, a natural response to perceived threats, can manifest in the investment world as a deep-seated worry about loss. When markets tumble, or when unsettling news emerges, fear can grip even seasoned investors, prompting them to sell their holdings at precisely the wrong moment. This impulse to flee from perceived danger, to cut losses before further erosion, often leads to selling low, locking in losses that might have been temporary. The fear of missing out on a potential recovery can also be a paralyzing force, keeping investors on the sidelines when opportunities arise. It's a powerful instinct, rooted in self-preservation, but in the context of investing, it can become a significant impediment to long-term wealth accumulation. Conversely, greed, the insatiable desire for more, can be an equally destructive influence. When markets are soaring and investments are rapidly appreciating, greed can whisper promises of even greater riches. This can lead investors to chase speculative bubbles, to invest in assets whose prices have outstripped their intrinsic value, driven by the hope of quick and substantial gains. The fear of missing out on these perceived windfalls fuels further irrational exuberance, pushing prices higher and higher until the inevitable correction. Greed can also lead to over-concentration in a few winning investments, ignoring the fundamental principles of diversification and risk management. It's the siren song of instant gratification, a dangerous distraction from the patient pursuit of sustainable growth. Benjamin Graham, the father of value investing, understood the profound impact of these emotions on market participants. He famously described the stock market as a, quote, voting machine in the short term, reflecting popularity and sentiment, but a weighing machine in the long term, reflecting true underlying value. The challenge for the disciplined investor lies in navigating the noisy, emotional short term, while remaining focused on the rational, long-term assessment of value. Cultivating emotional discipline, therefore, is not merely a desirable trait for an investor, it is a fundamental prerequisite for sustained success. It involves developing an inner resilience that can withstand the emotional storms of the market. This resilience is built not through suppressing emotions entirely, but by understanding them, acknowledging their presence, and consciously choosing not to be ruled by them. This process begins with a commitment to a well-defined investment philosophy, one grounded in thorough research and a clear understanding of a company's intrinsic worth. When an investor has conviction in the fundamental strength of their holdings, the short-term fluctuations of the market become less alarming. The focus shifts from the daily price movements to the long-term trajectory of the business. Patience is the cornerstone of this emotional discipline. Value investing is inherently a long-term endeavor. It requires the fortitude to hold onto quality assets during periods of market pessimism, trusting that their underlying value will eventually be recognized. It also requires the wisdom to resist the temptation to sell profitable investments prematurely, driven by the fleeting allure of immediate gains. Developing this emotional fortitude is a journey, not a destination. It involves continuous learning, self-reflection, and a willingness to confront one's own psychological biases. By understanding the insidious nature of fear and greed, and by actively practicing emotional discipline, investors can begin to build a robust framework for navigating the complexities of the market. This calm, rational approach, rooted in a deep appreciation for intrinsic value and a commitment to patience, is the bedrock upon which lasting investment success is built. It is a path that leads away from the volatile swings of speculation and towards the steady, enduring growth that true value investing promises. Benjamin Graham, a pioneer of value investing, introduced a powerful allegory to illustrate the often erratic nature of the stock market. Mr. Market. Imagine, if you will, a business partner who appears at your doorstep every single day, offering to buy your stake in a company or sell you his. This partner, Mr. Market, is prone to wild swings in mood. On some days, Mr. Market is ecstatic. He's overflowing with optimism, convinced that the future of every company is bright and that its stock is worth a fortune. On these days, he'll offer to buy your shares at incredibly high prices, prices that far exceed the true intrinsic value of the businesses. He's eager to part with his holdings, believing he's striking a brilliant deal, even as he overpays. On other days, Mr. Market is plunged into despair. He's gripped by pessimism, seeing only doom and gloom in the economic outlook. On these bleak days, he'll offer to sell you his shares at bargain basement prices, prices that are significantly lower than the underlying worth of the companies. He's desperate to offload his investments, convinced he's facing a catastrophe, even as he undervalues his assets. Graham's insight was that Mr. Market's moods are not driven by rational analysis or the fundamental performance of the businesses. Instead, his prices are dictated by emotion, by the prevailing sentiment of the crowd, and by short-term news that often has little bearing on long-term value. He is, in essence, irrational. The crucial lesson here is not to be swayed by Mr. Market's daily pronouncements. His offers, whether overly optimistic or excessively pessimistic, are opportunities, not mandates. A rational investor, unlike Mr. Market, focuses on the intrinsic value of a business, its assets, its earnings power, its future prospects, independent of the daily price fluctuations. When Mr. Market is in one of his jubilant moods, offering inflated prices, the wise investor simply ignores him. There is no need to sell just because Mr. Market is willing to pay a premium. The goal is not to time the market's irrational peaks. Conversely, when Mr. Market is depressed, offering shares at deeply discounted prices, this presents a golden opportunity. These are the moments when an investor can acquire valuable assets for far less than they are truly worth. It is during these periods of irrational fear that the disciplined value investor can find the best bargains. The key is to develop a detached perspective. Mr. Market is a tool, a source of potential transactions. But his opinions should not be taken as gospel. His daily price quotes are simply an invitation to consider a trade, an invitation that should only be accepted if the price aligns with the underlying value. By understanding Mr. Market's capricious nature, an investor can learn to use his moods to their advantage. Instead of being a victim of his fluctuations, one can become a beneficiary. This requires patience, discipline, and a deep understanding of what constitutes true value. The temptation to chase Mr. Market's highs or panic at his lows is immense. The constant barrage of news and the herd mentality can easily pull an individual into the emotional vortex of the market. However, the principles of value investing, as espoused by Graham, offer an anchor in this turbulent sea. By focusing on the long term, on the fundamental strength of businesses, and by viewing Mr. Market's daily offers as mere suggestions, an investor can navigate the market with a greater degree of serenity and success. It is a journey that rewards careful analysis, emotional control, and a steadfast commitment to buying value, not just price. Mr. Market will continue his daily dance, but the discerning investor can choose to observe, to analyze, and to act only when the numbers truly make sense, transforming his irrationality into a pathway to enduring wealth. The principle of spreading investments, often referred to as diversification, is a cornerstone of prudent financial management. It speaks to a fundamental truth that concentrating all resources into a single venture or a small group of closely related ventures inherently carries a higher degree of risk. This is not a new concept. It is echoed in ancient wisdom, a reminder to avoid placing all one's hopes, or indeed all one's assets, into a single potentially fragile basket. When applied to an investment portfolio, diversification means strategically allocating capital across a variety of asset classes, industries, and even geographic regions. The goal is not simply to own many different things, but to own things that behave differently under various economic conditions. For instance, a company in the technology sector might perform exceptionally well during periods of rapid innovation, while a utility company might offer stability and consistent returns during economic downturns. By holding both, an investor can potentially cushion the impact of a downturn in one sector with the resilience of another. This careful balancing act is designed to reduce overall portfolio risk. It acknowledges that no single investment is guaranteed to perform well at all times. Market fluctuations, industry-specific challenges, and unforeseen global events can all impact the value of individual holdings. Diversification acts as a buffer, smoothing out the inevitable ups and downs. When one investment experiences a decline, others in the portfolio may remain stable or even appreciate, thereby mitigating the overall loss. Crucially, wise diversification does not necessarily mean sacrificing potential returns. The aim is to achieve a more favorable risk-adjusted return. This means seeking the highest possible return for a given level of risk, or conversely, the lowest possible risk for a desired level of return. It is about optimizing the trade-off, not about abandoning the pursuit of growth. A well-diversified portfolio can still capture significant upside potential from various market opportunities, while being less susceptible to catastrophic losses from any single adverse event. Consider the analogy of a gardener. A gardener who plants only one type of fruit might face ruin if a disease specific to that fruit sweeps through the region. However, a gardener who cultivates a variety of fruits, vegetables, and herbs is far more resilient. A blight on one crop might affect a portion of their harvest, but their overall livelihood remains secure, supported by the other thriving plants. The same logic applies to the investor. By spreading investments across different types of companies, such as those in consumer staples, healthcare, energy, and financial services, an investor creates a more robust portfolio. Different industries are influenced by distinct economic drivers. Consumer staples, for example, tend to be less sensitive to economic cycles because people always need food and basic necessities. Healthcare, while also somewhat defensive, can be driven by innovation and demographic trends. Energy prices fluctuate with global supply and demand, and financial services are intrinsically linked to the broader economy's health. Furthermore, diversification can extend beyond industry sectors to include different asset classes. This might involve holding not just stocks, but also bonds, real estate, or even commodities. Bonds, typically considered less volatile than stocks, can provide a steady stream of income and act as a ballast during stock market turbulence. Real estate can offer rental income and potential appreciation, often with a correlation to economic conditions that differs from that of equities. The key to successful diversification lies in thoughtful selection and ongoing rebalancing. It is not a passive strategy of simply buying a little bit of everything. Instead, it requires understanding the interplay between different assets and ensuring that the portfolio remains aligned with the investor's long-term goals and risk tolerance. Periodically reviewing and adjusting holdings, a process known as rebalancing, is essential to maintain the desired level of diversification as market values shift. This disciplined approach ensures that the portfolio does not become overly concentrated in any single area due to exceptional performance, thereby preserving the benefits of diversification. It is a testament to the power of patience and strategic planning in building lasting financial security. The pursuit of a resilient investment portfolio often leads to the concept of diversification. It is a strategy that seeks to mitigate risk by spreading investments across various assets, industries, and geographies. However, a crucial distinction exists between meaningful diversification and its potential extreme, over-diversification. Meaningful diversification is about thoughtful construction. It involves identifying asset classes that do not move in perfect unison, thereby reducing the impact of any single investment's poor performance on the overall portfolio. This approach is rooted in the understanding that different sectors of the economy, and indeed different types of assets, respond to economic forces in varied ways. For instance, during periods of economic expansion, certain growth-oriented sectors might flourish, while in times of contraction, more defensive industries or assets like bonds might offer stability. A well-diversified portfolio aims to capture upside potential from various sources while cushioning against significant downturns. It is a deliberate balancing act, ensuring that a setback in one area does not jeopardize the entire investment thesis. This thoughtful approach aligns directly with the principles of value investing. By identifying truly undervalued companies, investors are seeking businesses with intrinsic worth that is not yet recognized by the broader market. When diversifying, the goal is to find undervalued opportunities across different industries, each with its own unique catalysts for growth or recovery. It's about building a collection of strong, fundamentally sound businesses that individually have the potential to appreciate and collectively offer a buffer against unforeseen market shocks. The focus remains on the quality and valuation of each individual holding, ensuring that diversification does not lead to the inclusion of weaker or speculative assets simply to fill a perceived gap. Over-diversification, on the other hand, can dilute the benefits of concentrated conviction. It occurs when an investor holds so many disparate assets that the portfolio becomes unwieldy and difficult to manage effectively. In this scenario, the potential gains from any single successful investment are diminished due to their small allocation within the vast portfolio. More importantly, the ability to thoroughly research and understand each individual holding can become compromised. The investor might end up owning a large number of assets that are only superficially understood, leading to a loss of focus on the core principles of value. When a portfolio becomes too broad, it can also lead to a situation where the investor is neither benefiting from the potential outperformance of their best ideas, nor adequately protected by the diversification itself. The individual holdings may become so small that their impact on the overall portfolio's performance is negligible. This can create a false sense of security, as the portfolio appears diversified, yet it may not offer true resilience. It's akin to owning a little bit of everything, but not enough of anything to truly matter. The teachings of Benjamin Graham and Warren Buffett emphasize deep understanding and conviction. Graham, in his seminal work The Intelligent Investor, advocated for a margin of safety which is best achieved through thorough analysis of individual companies. Buffett, a devoted disciple of Graham, is known for his concentrated portfolios, investing heavily in businesses he understands deeply and has high conviction in. This does not mean they shun diversification entirely, but rather that their diversification is purposeful. They seek to diversify across industries and economic cycles, but within the realm of businesses they have rigorously analyzed and believe in. Therefore, the aim is not to own a piece of every available investment, but to own a carefully selected collection of undervalued assets that offer genuine potential for long-term growth. It is about finding a balance where the portfolio is broad enough to spread risk, yet concentrated enough to allow for deep conviction and effective management. This thoughtful diversification strategy prioritizes quality over quantity, ensuring that each investment contributes meaningfully to the overall objective of building enduring wealth. It is a patient approach, recognizing that true value takes time to materialize, and that a well-constructed, thoughtfully diversified portfolio is a cornerstone of that long-term success. The world of investing, at its core, is a testament to the power of time. While the allure of quick gains can be captivating, a deeper understanding reveals the profound advantages of patience. This is particularly true when considering the principle of compounding, a force that, when allowed to work its magic over extended periods, can transform modest beginnings into significant wealth. Compounding is often described as the eighth wonder of the world, and for good reason. It's the process where earnings from an investment are reinvested, generating further earnings. This creates a snowball effect, where growth accelerates over time. The initial gains are small, almost imperceptible, but as the years pass, the accumulated interest or profits begin to earn interest themselves, leading to exponential growth. This phenomenon is not a rapid surge. It is a slow, steady accumulation, a testament to the virtue of waiting. Consider the journey of an investment held for a decade, or even two. In the early years, the impact of compounding might seem negligible. However, as the principal grows and the earnings are consistently reinvested, the growth rate itself begins to climb. This is where patience becomes not just a desirable trait, but a powerful strategy. It allows the investor to harness the full potential of this compounding effect, avoiding the temptation to disrupt the process through frequent trading or premature withdrawals. The philosophy of value investing, championed by pioneers like Benjamin Graham and refined by Warren Buffett, inherently embraces this long-term perspective. Value investors seek companies that are temporarily undervalued by the market, believing that their intrinsic worth will eventually be recognized. This process of identification and subsequent waiting for market correction requires a deep well of patience. It is not about predicting short-term market fluctuations, but about understanding the fundamental strength and enduring value of a business. When an investor identifies such an opportunity, the act of holding that investment becomes paramount. It is during this holding period that the company has the opportunity to execute its business plan, grow its earnings, and, in turn, for the investor's capital to appreciate. This appreciation is not solely driven by market sentiment, but by the tangible improvements in the company's performance. This is where the virtue of waiting truly shines. It allows the investor to benefit from the company's operational success and the compounding of its profits, which eventually translate into a higher stock price. The temptation to react to every market tremor, to buy and sell based on daily news or fleeting trends, is a constant challenge. However, a disciplined approach, rooted in the principles of value investing, recognizes that such reactions often detract from long-term returns. Instead, patience allows for a focus on the underlying fundamentals of the investment. It encourages a deep dive into the company's financials, its competitive landscape, and its management quality. This thorough analysis, combined with the willingness to wait, forms the bedrock of a robust investment strategy. The benefits of holding investments for extended periods extend beyond just financial returns. It fosters a sense of calm and reduces the stress often associated with speculative trading. By adopting a long-term view, investors can detach themselves from the daily noise of the market and focus on the larger picture. This detachment, cultivated through patience, allows for more rational decision-making and a greater appreciation for the slow, steady growth that characterizes sustainable wealth creation. In essence, the virtue of waiting and investing is an acknowledgement of how time and consistent effort can yield remarkable results. It is a call to embrace a strategy that prioritizes long-term value over short-term gratification. By understanding and applying the principles of compounding and the wisdom of value investing, one can cultivate the patience necessary to navigate the markets with a sense of purpose and a clear vision for enduring financial well-being. This patient approach, allowing time to work its transformative power, is a cornerstone of building lasting wealth. The pursuit of wealth through investment often encounters a fundamental question. Should one attempt to master the volatile currents of the market, or instead, embrace a more patient, consistent approach? The wisdom of seasoned investors, particularly those inspired by the foundational principles of Benjamin Graham and the enduring success of Warren Buffett, points towards the latter. This perspective emphasizes the profound advantage of time in the market, not timing the market. The allure of predicting market movements, identifying the exact peak before a decline, or the precise trough before a surge, is undeniably powerful. It suggests a level of control, an almost prescient ability to outmaneuver the collective sentiment of millions. However, history and statistical analysis reveal a stark reality. Consistently and patiently investing over extended periods, regardless of short-term market fluctuations, has historically yielded superior results for the vast majority. The endeavor to perfectly time the market is, for most, an exercise in futility, a source of anxiety, and often a path to suboptimal returns. Consider the nature of markets. They are complex ecosystems, influenced by a myriad of factors, from economic indicators and geopolitical events to shifts in consumer behavior and technological innovation. Predicting these interwoven forces with consistent accuracy is a task that has eluded even the most brilliant minds. The human tendency towards emotional decision-making, fear during downturns, greed during upturns, further complicates the act of timing. A strategy focused on timing often leads to buying high out of optimism and selling low out of panic, a cycle that erodes capital. In contrast, the principle of time in the market advocates for a disciplined, long-term perspective. It involves identifying fundamentally sound businesses, those with strong balance sheets, sustainable competitive advantages, and capable management, when they are trading at valuations below their intrinsic worth. Once such an investment is made, the focus shifts from daily price movements to the long-term growth and profitability of the underlying business. This approach allows the power of compounding to work its magic, where earnings are reinvested, generating further earnings over time. This method offers a profound sense of peace of mind. Instead of constantly monitoring charts and news feeds, the investor can approach their portfolio with a calm assurance. The knowledge that one is invested in quality businesses, purchased at reasonable prices, provides a buffer against the inevitable market volatility. Downturns are not seen as catastrophic events, but rather as opportunities to acquire more shares of well-chosen companies at discounted prices, further enhancing the long-term potential of the portfolio. The process begins with diligent research. It requires understanding the business models of companies, their competitive landscapes, and their financial health. It involves looking beyond the superficial price fluctuations and delving into the core value of the enterprise. This might mean identifying a company whose stock has been temporarily overlooked due to broader market sentiment, or one that is experiencing a short-term operational challenge that does not fundamentally impair its long-term prospects. The goal is to acquire these valuable assets at a discount, much like purchasing a quality item on sale. Once these investments are made, patience becomes the most valuable tool. The market will fluctuate. There will be days, weeks, and even months of decline. However, by remaining invested in fundamentally strong companies, the investor allows the underlying value of these businesses to manifest over time. This patient accumulation and holding strategy allows for the benefits of dividends to be reinvested and for the company's growth to translate into capital appreciation. The peace of mind derived from this approach is incalculable. It frees the investor from the stress and emotional turmoil associated with trying to predict the unpredictable. It fosters a sense of control, not through market manipulation, but through a steadfast adherence to sound principles and a deep trust in the long-term growth potential of well-chosen businesses. This is the essence of value investing, a journey of patient accumulation, disciplined analysis, and ultimately, a more serene path to financial well-being. It is a testament to the power of allowing time and the intrinsic value of sound businesses to do the heavy lifting, fostering not just wealth but also a tranquil mind. The economic landscape is not a static terrain, but rather a dynamic environment characterized by predictable, yet often unsettling, cycles. Like the ebb and flow of tides, economies and financial markets naturally expand and contract, moving through distinct phases of growth and slowdown. Understanding this cyclical nature is a cornerstone of sound investing, offering a vital perspective that transcends short-term volatility. During periods of expansion, often referred to as booms, optimism tends to pervade the market. Businesses thrive, employment rises, and consumer spending increases. This can lead to a surge in asset prices, including stocks, as investors anticipate continued growth and profitability. It is a time when many feel confident, and the allure of quick gains can be strong. However, even in these prosperous times, the seeds of future contraction are often being sown. Conversely, contractions or recessions mark periods where economic activity slows. Businesses may face declining revenues, leading to layoffs and reduced consumer demand. Market sentiment can shift dramatically, turning from exuberance to caution, and sometimes even to outright fear. During these downturns, asset prices can fall, sometimes sharply, as investors reassess risk and seek safety. It is in these challenging moments that the true test of an investor's resolve is often encountered. These cycles are not new. They have been an intrinsic part of economic history for centuries. While the duration and intensity of each cycle can vary, their recurring pattern remains a constant. Recognizing this inherent rhythm helps to temper emotional responses to market movements. When markets are soaring, it is important to remember that such periods are not permanent. Similarly, during periods of decline, it is crucial to recall that contractions are also temporary and often pave the way for renewed growth. For the patient investor, these cycles present opportunities. During times of economic expansion, it is prudent to focus on identifying fundamentally sound companies that may be trading at reasonable valuations, even amidst general market enthusiasm. The temptation to chase speculative assets during a bull market can be powerful, but a disciplined approach emphasizes intrinsic value over fleeting trends. Conversely, it is during periods of economic contraction that some of the most compelling investment opportunities can emerge. As fear grips the market, even high-quality companies with strong balance sheets and enduring business models can see their stock prices fall, often to levels that do not reflect their true underlying worth. Benjamin Graham, the father of value investing, famously advised to be fearful when others are greedy, and greedy when others are fearful. This principle is particularly relevant during market downturns. By maintaining a long-term perspective, investors can weather the storms of economic contractions and emerge stronger. Instead of reacting impulsively to price drops, a value-oriented approach encourages a deeper analysis of a company's fundamentals. Are the earnings sustainable? Is the debt manageable? Does the company possess a competitive advantage? These are the questions that guide an investor through the noise of market fluctuations. Patience, therefore, is not merely a virtue in investing, it is a necessity. It allows one to wait for the right opportunities, to endure periods of underperformance, and to benefit from the eventual recovery and growth of sound businesses. Understanding that economies and markets move in cycles provides a framework for this patience, transforming potential anxieties into strategic advantages. It is this informed perspective, grounded in the understanding of economic rhythms and a commitment to intrinsic value, that forms the bedrock of a resilient and successful investment journey. Market downturns, periods of economic contraction and investor uncertainty, often evoke feelings of anxiety. The value of assets can decline, and the future may seem less predictable. Yet within these challenging phases lies a profound opportunity for the discerning investor. It is during these times of widespread concern that quality assets, those fundamentally sound businesses with strong long-term prospects, can become available at significantly reduced prices. This concept, central to the philosophy of value investing, encourages a perspective shift. Instead of reacting to short-term volatility with fear, one can begin to see downturns as a unique window to acquire valuable holdings at a discount. Imagine a well-crafted piece of art temporarily available at a fraction of its usual price due to circumstances unrelated to its intrinsic beauty or historical significance. Similarly, a robust company, perhaps temporarily impacted by broader economic headwinds or market sentiment, may find its stock trading below its true worth. The key to capitalizing on these moments is patience. Patience allows for careful observation, for the emotional storms of the market to subside, and for a clearer assessment of underlying value to emerge. It is the ability to resist the urge to panic sell when prices fall, and instead to consider the possibility of strategic acquisition. This requires a deep understanding of what constitutes true value, not just the current market price, but the long-term earning power, the management quality, and the competitive advantages of a business. Benjamin Graham, a pioneer in value investing, emphasized the importance of a margin of safety. This margin is essentially a buffer, a difference between the intrinsic value of an asset and its market price. Downturns can widen this margin, presenting an ideal environment to find investments that offer a substantial cushion against unforeseen risks. Warren Buffett, a devoted student of Graham, has often spoken of his preference for buying wonderful companies at fair prices, or even good companies at wonderful prices. Market downturns can provide opportunities for the latter. The process involves diligent research and a commitment to understanding the businesses being considered. It means looking beyond the daily fluctuations of the stock market and delving into the fundamentals: the company's balance sheet, its revenue streams, its profitability, its debt levels, and its competitive landscape. A downturn does not negate the need for this rigor. In fact, it amplifies its importance. It is during these periods that the underlying strength or weakness of a business becomes even more apparent. Patience also plays a crucial role in the holding period. Value investors are not typically seeking rapid gains. Instead, they are looking to hold quality assets for the long term, allowing the inherent value of the business to be recognized by the market over time. This long-term perspective is what allows the benefits of compounding to take effect and shields the investor from the temptation of frequent and often detrimental trading. When the market is in a state of euphoria, it can be difficult to find attractive opportunities. Prices may already reflect optimistic future expectations, leaving little room for upside. Conversely, when fear grips the market, often justified or not, it can create a landscape where sound investments are overlooked or undervalued. This is where the disciplined investor can find their advantage. The ability to remain calm and rational during periods of market stress is a significant psychological advantage. It allows for objective decision-making, free from the emotional contagion that often drives speculative behavior. By cultivating this inner fortitude, an investor can navigate the inevitable cycles of the market with a greater sense of purpose and a clearer vision of their long-term goals. Therefore, while downturns may present challenges, they also offer a unique and valuable opportunity. They are a reminder that the market, while often irrational in the short term, can be a powerful ally to those who approach it with knowledge, discipline, and a healthy dose of patience. By understanding the principles of value investing and embracing a long-term perspective, one can transform periods of economic uncertainty into fertile ground for building lasting wealth. The quiet accumulation of quality assets during times of unease, followed by the patient waiting for their true value to be realized, is a cornerstone of successful investing. As the seasons change, so too can the landscape of an investment portfolio. For those who seek not just growth, but a consistent return, dividend-paying stocks offer a unique and compelling path. These are companies that, by their very nature, share a portion of their profits directly with their owners. It is a tangible reward for holding a stake in their success, a regular affirmation of the value created. Imagine a well-tended garden. Each year, it yields its harvest. In a similar fashion, a dividend-paying company, when performing well, can provide a steady stream of income. This income can be reinvested, compounding over time, or it can be used to supplement daily life, offering a sense of financial stability. It's a testament to the enduring principles of value investing, where patience and thoughtful selection are paramount. Benjamin Graham, the father of value investing, emphasized the importance of understanding the underlying business. He taught that a stock is not merely a ticker symbol, but a fractional ownership in a real enterprise. When that enterprise prospers, it has the capacity to reward its partners. Warren Buffett, a devoted disciple of Graham's philosophy, has often highlighted the power of dividends. He views them as a significant component of long-term investment returns, a clear sign of a company's robust health and its commitment to its shareholders. The process of identifying such companies requires diligent research and a long-term perspective. It involves looking beyond the daily fluctuations of the market and focusing on the intrinsic value of a business. What are its assets? What are its earnings power? Does it possess a durable competitive advantage, a moat that protects it from rivals? And crucially, does it have a history of consistently paying, and ideally growing, its dividends? These are not speculative ventures. They are investments in established businesses with proven track records. Companies that generate consistent cash flow, manage their debt prudently, and allocate capital wisely are more likely to maintain and even increase their dividend payouts. This reliability can provide a comforting rhythm to an investment strategy, a predictable income that can weather economic storms. The allure of dividends extends beyond the purely financial. For many, it provides a sense of security, a feeling of being connected to the ongoing success of the companies they own. It transforms the abstract concept of ownership into a concrete benefit, received on a regular basis. This can be particularly valuable during periods of market uncertainty, when the steady income from dividends can offer a reassuring counterbalance to volatility. Building a portfolio of dividend-paying stocks is a journey that rewards patience. It is about selecting companies with strong fundamentals, a commitment to returning value to shareholders, and the potential for long-term growth. These are not get-rich-quick schemes, but rather thoughtful allocations of capital into businesses that are built to last. The income generated from dividends can be a powerful tool in achieving financial goals. It can be used to fund retirement, to support charitable endeavors, or simply to enhance one's lifestyle. The key is to approach this strategy with the same discipline and foresight that underpins all successful value investing. Understand the business, assess its long-term prospects, and let the power of compounding and consistent income work its magic. In essence, dividend-paying stocks represent a harmonious blend of growth potential and income generation. They are the fruits of a company's labor, shared with those who have invested in its future. It is a practice rooted in the wisdom of Graham and Buffett, a testament to the enduring power of owning pieces of sound, profitable businesses. This steady, reliable income stream, a tangible reward for ownership, can be a cornerstone of a resilient and fulfilling investment journey. The journey of building enduring wealth often involves understanding the subtle yet profound power of compounding. Within the realm of investing, a particularly elegant method for harnessing this force is through dividend reinvestment plans, often referred to as DRIPs. Imagine a company that not only generates profits but also shares a portion of those profits with its shareholders. These distributions are known as dividends. When an investor participates in a dividend reinvestment plan, these dividends are not paid out in cash. Instead, they are automatically used to purchase more shares of the same company. This creates a virtuous cycle, where the earnings from the investment are immediately put back to work, generating further earnings. This process is the essence of compounding in action. Each dividend payment, when reinvested, buys additional shares. These new shares then begin to earn their own dividends, which are also reinvested. Over time, this accumulation accelerates. The growth is not linear, it is exponential. The initial investment, combined with the steadily increasing number of shares, results in a significantly larger stake in the company than would have been possible through simply holding the dividends as cash. This strategy is particularly appealing for those with a long-term investment horizon. Patience is a cornerstone of successful value investing, and DRIPs embody this principle. They encourage a hands-off approach, allowing the investment to grow organically without constant intervention. The automatic nature of reinvestment removes the temptation to spend dividends or to second-guess market timing. The focus shifts from short-term fluctuations to the steady long-term accumulation of assets. Consider the wisdom of Benjamin Graham, the father of value investing. Graham emphasized the importance of buying companies at a price below their intrinsic value. When coupled with a disciplined reinvestment strategy, this approach can lead to remarkable wealth creation. By acquiring shares of sound businesses at attractive valuations, and then allowing the dividends to compound, an investor effectively buys more of a good thing, over time, at a favorable price. Warren Buffett, Graham's most famous protege, has often spoken about the benefits of owning wonderful companies at fair prices. Dividend reinvestment aligns perfectly with this philosophy. It allows one to continually increase their ownership in these wonderful companies without requiring additional capital outlays from their personal income. The company's own success, shared through dividends, becomes the engine for further ownership growth. The beauty of DRIPs also lies in their accessibility. Many companies offer these plans directly to shareholders, allowing for easy enrollment. In some cases, these plans even offer shares at a slight discount, further enhancing the compounding effect. This makes disciplined, long-term wealth building accessible to a wide range of investors. The strategy is not about chasing speculative gains or trying to time the market. It is about embracing the fundamental principles of ownership and growth. It is about allowing the inherent value of a business to translate into an ever larger stake for the investor. It requires a degree of faith in the underlying business and a commitment to letting time do its work. The compounding effect of dividend reinvestment, when applied to carefully selected, undervalued companies, can transform a modest investment into a substantial portfolio over decades. It is a testament to the power of patience, discipline, and the quiet strength of consistent growth. This method offers a serene path to financial progress, where earnings are not merely received, but are actively and automatically engaged in the pursuit of greater returns, fostering a sense of steady accumulation and long-term security. The allure of quick riches can be a powerful siren song, drawing many towards the glittering promise of rapid gains. This chapter delves into the phenomenon of speculative bubbles and fleeting fads, examining how they capture the public imagination and the perils of succumbing to their seductive charm. History is replete with examples of manias, from tulip bulbs in 17th century Holland to the dot-com boom of the late 20th century. These periods are characterized by an intense, often irrational, enthusiasm for a particular asset or industry. prices surge far beyond any intrinsic value, fueled by a collective belief that the trend will continue indefinitely. The underlying fundamentals of the businesses involved often become secondary, if considered at all. Instead, the focus shifts to market sentiment, the fear of missing out, and the ever-present hope of a swift and substantial profit. During these times, it is easy to be swept away by the prevailing optimism. Stories of overnight millionaires abound, and the perceived wisdom of the crowd can feel overwhelming. Yet, beneath the surface of this frenzied activity often lies a dangerous disconnect from reality. Businesses that hold little genuine promise or possess unsustainable business models can command exorbitant valuations, simply because they are the current darlings of the market. The narrative surrounding these assets becomes more important than their actual performance or long-term viability. Recognizing these patterns requires a disciplined approach, one that prioritizes understanding over speculation. The teachings of value investing, championed by figures like Benjamin Graham and Warren Buffett, offer a powerful antidote to the allure of fads. This philosophy emphasizes a deep dive into the fundamentals of a business. It involves scrutinizing financial statements, understanding the competitive landscape, assessing the quality of management, and evaluating the long-term prospects of the company. The goal is not to predict the next hot trend, but to identify companies that are genuinely undervalued by the market, trading at a price significantly below their true worth. Chasing speculative bubbles often leads to significant losses when the inevitable correction occurs. The air rushes out of the balloon, and prices plummet, leaving those who invested at the peak with substantial regret. This is where the principle of sticking to one's core principles becomes paramount. For the value investor, these principles are rooted in patience, rationality, and a commitment to thorough research. It means resisting the urge to jump on every new bandwagon, and instead focusing on established methodologies that have proven their worth over time. Understanding a business is not merely about understanding its current stock price or the latest news headlines. It involves comprehending its revenue streams, its cost structure, its competitive advantages, and its potential for future growth. When an investment opportunity arises, it should be one where the investor has a clear grasp of what they are buying. If a business model is opaque, or its success relies on factors that are difficult to ascertain or predict, it is often wise to let it pass. The universe of investment opportunities is vast, and there are always sound businesses available for those willing to do the work. The fad investor might see a rising stock price and immediately invest, hoping to ride the wave. The value investor, however, sees a rising stock price and asks why. Is it due to genuine improvement in the company's performance, or is it simply the result of speculative fever? This critical distinction is the cornerstone of avoiding the pitfalls of speculative bubbles. Patience is another vital virtue in this context. Bubbles inflate gradually, and they also deflate gradually. The temptation is to exit too late, or to enter too late, driven by emotion rather than logic. Value investing, conversely, is a long-term game. It acknowledges that it may take time for the market to recognize the true value of an undervalued company. This requires a strong conviction in one's analysis and the fortitude to hold on through market fluctuations, knowing that the underlying intrinsic value will eventually be reflected in the stock price. By cultivating a deep understanding of businesses and adhering to proven investment principles, one can navigate the often turbulent waters of the financial markets. This approach fosters a sense of control and reduces reliance on the unpredictable whims of market sentiment. It is a path that emphasizes thoughtful analysis, disciplined execution, and a quiet confidence in the enduring power of intrinsic value. The allure of amplified returns can be tempting, particularly in the world of investing. This often manifests as leverage, the use of borrowed money to increase potential gains. While leverage can magnify profits when investments perform well, it carries a significant and often underestimated danger: the amplification of losses. Imagine a simple scenario. An investor holds an asset worth $100. If the asset increases in value by 10%, it becomes $110, a gain of $10. However, if that same investor had used $50 of their own money and borrowed $50 to purchase the asset, a 10% increase in the asset's value would still result in the asset being worth $110. The investor's initial $50 has now grown to $60. This represents a 20% gain on their initial capital. The leverage has indeed doubled the percentage return. Now consider the downside. If the asset's value declines by 10%, it falls to $90. In the unleveraged scenario, the investor experiences a $10 loss, a 10% reduction of their initial capital. But with the leveraged position, the asset is now worth $90. The investor still owes the $50 they borrowed. Their remaining capital is $40, $90 asset value minus $50 debt. This represents a loss of $10 on their initial $50 investment, a 20% decline. The leverage, which amplified gains, has also doubled the percentage loss. This amplification of risk is a critical concept for the prudent investor. Value investing, as championed by pioneers like Benjamin Graham and further refined by Warren Buffett, places a profound emphasis on financial prudence. A cornerstone of this philosophy is the avoidance of excessive debt, both for the individual investor and for the companies they choose to invest in. Companies burdened by significant debt face greater financial fragility. In times of economic downturn or unexpected challenges, high debt levels can quickly become a crushing weight. Interest payments must be met, regardless of profitability, and the principal must eventually be repaid. This can force companies to make difficult decisions, such as selling assets at unfavorable prices, cutting essential research and development, or even facing bankruptcy. Such outcomes are devastating for shareholders. The value investor seeks companies with strong balance sheets, characterized by ample cash reserves and manageable debt. These companies possess the resilience to weather economic storms and emerge stronger. They are not reliant on borrowed money to sustain their operations or to fund growth. This financial strength provides a margin of safety, a buffer against unforeseen circumstances. Leverage, in essence, introduces a form of financial fragility. It increases the probability of significant financial distress. The value investor, by prioritizing financial conservatism, seeks to minimize this fragility. They understand that consistent long-term wealth creation is built on a foundation of stability and resilience, not on the precarious structure of borrowed funds. The pursuit of quick, amplified gains through leverage often leads to impulsive decisions and heightened emotional stress. The value investor, however, embraces patience. They understand that identifying truly undervalued companies requires diligent research and a long-term perspective. They are willing to wait for the market to recognize the intrinsic value of a business, rather than seeking to force rapid returns through the use of borrowed money. This commitment to financial prudence extends beyond the companies themselves. The disciplined value investor typically avoids using leverage in their personal investment portfolios. They understand that their own capital is their primary tool, and they are loath to expose it to the amplified risks that borrowing entails. The focus remains on preserving capital and achieving steady compounding growth over extended periods. This patient, conservative approach, free from the seductive but dangerous allure of leverage, is a hallmark of true value investing. The pursuit of sound investment strategy often involves a delicate balance. It is the art of staying informed, of understanding the currents that shape financial markets, without becoming adrift in a sea of constant news and speculation. This is not about consuming every headline, every market fluctuation, but rather about cultivating a discerning approach, focusing on the signals that truly matter for long-term value. Consider the investor who seeks to understand the rhythm of the economy and the performance of their chosen enterprises. This understanding is built not on the frantic pursuit of daily price movements, but on a consistent, measured engagement with reliable information. It involves recognizing that the most impactful insights often emerge from thoughtful analysis, not from impulsive reactions. The goal is to develop a mental framework that filters the noise, allowing for a clear view of the underlying fundamentals. This process begins with identifying dependable sources. Think of reputable financial news outlets that prioritize in-depth reporting over sensationalism. Consider the annual reports of companies, the filings with regulatory bodies, and the analyses from trusted economic institutions. These are the bedrock upon which informed decisions are built. It is in these documents that the true story of a company's health, its competitive landscape, and its future prospects are often revealed. The key lies in developing a habit of regular but not obsessive review. Just as a gardener tends to their plants with consistent care, the informed investor dedicates time to understanding their portfolio and the broader economic environment. This might involve setting aside a specific time each week, or perhaps each month, to review key metrics, industry trends, and company-specific news. This structured approach prevents information from becoming an overwhelming tide, instead transforming it into a valuable resource. Furthermore, it is crucial to differentiate between information that impacts long-term value and that which represents short-term noise. A minor, temporary dip in a company's stock price, for instance, may be insignificant in the grand scheme of things if the underlying business remains strong and its long-term prospects are intact. Conversely, a fundamental shift in an industry, a new disruptive technology, or a significant change in a company's management team, these are the pieces of information that warrant deeper consideration. Patience is an essential companion to this informed approach. The market, in its inherent complexity, will inevitably present periods of uncertainty and volatility. It is during these times that a calm, informed perspective proves most valuable. Instead of reacting with fear or anxiety, the disciplined investor draws upon their understanding of the fundamentals, trusting in the long-term potential of well-chosen assets. They recognize that true value is often built over time, through consistent effort and a steadfast adherence to sound principles. This mindful engagement with information also fosters a sense of control. When one is actively seeking to understand, rather than passively absorbing, there is a greater sense of agency. It is about being in command of one's financial journey, equipped with the knowledge to make reasoned decisions. This empowerment comes from the deliberate cultivation of an informed perspective, one that prioritizes understanding over reaction and long-term vision over short-term fluctuations. By focusing on what truly matters, the investor can navigate the complexities of the financial world with a quiet confidence, building a foundation for enduring success. The journey of a value investor is not one of static dogma, but of continuous evolution. While the foundational principles, the bedrock established by thinkers like Benjamin Graham, remain steadfast, the pursuit of intrinsic value, the margin of safety, the understanding of a business as a partnership, the investor's perception and execution of these principles will inevitably deepen over time. Experience, that most potent of teachers, refines the lens through which opportunities are viewed. Initially, the search for undervalued companies might feel like a meticulous, almost academic exercise. It involves poring over financial statements, dissecting balance sheets, and estimating future cash flows with a degree of precision that can seem daunting. This early stage often emphasizes quantifiable metrics, seeking out businesses trading at a significant discount to their book value or earnings power. It is a period of rigorous learning, of building the mental toolkit necessary to navigate the often turbulent waters of the stock market. As time progresses, however, a subtle yet profound shift occurs. The investor begins to develop a more nuanced understanding of what constitutes true value. This goes beyond mere numbers on a spreadsheet. It encompasses the qualitative aspects of a business, the strength of its management team, the durability of its competitive advantages, what Warren Buffett famously terms its economic moat, the clarity of its business model, and its ability to adapt to changing market dynamics. The investor learns to recognize that a cheap stock is only a good investment if the underlying business is sound. This refinement is not about abandoning the core tenets, but about enriching them with practical wisdom. The margin of safety, for instance, is no longer solely a numerical buffer against analytical error. It becomes a more holistic concept, encompassing not just the price paid relative to intrinsic value, but also the confidence in the long-term prospects of the business and the stability of its industry. A deep understanding of a company's competitive landscape, its customer loyalty, and its innovative capacity contribute to a more robust sense of security. The process is akin to a sculptor working with stone. The initial chiseling reveals the rough form, but with patient and skilled strokes, the finer details emerge, bringing the true artistry to light. Similarly, the value investor, through years of observation and analysis, learns to discern the subtle strengths and potential weaknesses that might escape a less experienced eye. They develop an intuition, honed by countless hours of study and real-world application, that complements their analytical rigor. Embracing ongoing learning is paramount. The business world is in constant flux. New technologies emerge, consumer preferences shift, and regulatory landscapes evolve. A truly dedicated value investor understands that their education is never complete. They remain curious, open to new information, and willing to challenge their own assumptions. This might involve reading industry reports, following economic trends, or even delving into the history of successful and unsuccessful businesses. Thoughtful adjustments to one's approach are also a hallmark of a mature value investor. This does not imply impulsive reactions to market fluctuations. Rather, it speaks to a willingness to adapt one's investment strategy as new information comes to light, or as the investor's own understanding evolves. Perhaps an initial investment thesis needs to be revisited in light of unforeseen challenges or opportunities. The key is to make these adjustments with deliberation, grounded in the original principles of value investing, rather than succumbing to short-term sentiment. The patience cultivated over years of investing becomes an invaluable asset. The investor learns to resist the siren song of quick profits and understands that true wealth creation in value investing is a marathon, not a sprint. They are content to let their well-chosen investments mature, allowing the power of compounding to work its magic. This long-term perspective allows them to weather market downturns with equanimity, recognizing that volatility is often a temporary phenomenon, while the underlying value of a sound business endures. Ultimately, refining one's approach over time is about achieving a deeper, more integrated understanding of value investing. It is about moving beyond a purely mechanical application of rules to a more profound appreciation of business fundamentals and market dynamics. This ongoing journey of learning, adaptation, and patient observation is what transforms a novice investor into a seasoned practitioner, capable of consistently identifying and capitalizing on opportunities for long-term wealth accumulation. The practice of investing can often feel abstract, a mere exchange of digital figures or printed certificates. Yet, beneath this surface lies a profound truth. Buying a stock is not simply acquiring a piece of paper. It is, in essence, purchasing a small ownership stake in a tangible, operating business. This distinction is fundamental to developing an ownership mentality, a perspective that cultivates a deeper appreciation for the true underlying value of an enterprise. Consider a local bakery a familiar establishment within a community. When one invests in such a business, they are not just buying a name on a ticker. They are becoming a partner, however small, in the daily operations. They share in the triumphs of a well-baked loaf, the success of a popular new pastry, and the steady hum of contented customers. Conversely, they also bear a fraction of the challenges: the rising cost of ingredients, unexpected equipment repairs, or shifts in consumer preference. This shared experience, this participation in the real-world functioning of the business, fosters a sense of connection and responsibility. This ownership mentality encourages a shift in focus from short-term price fluctuations to the long-term health and growth of the business itself. Instead of reacting to daily market noise, the owner-investor seeks to understand the business's competitive advantages, its management quality, its products or services, and its potential for future profitability. This involves a more patient and thoughtful approach, akin to nurturing a garden rather than chasing fleeting trends. The value investor, guided by this ownership perspective, looks beyond the immediate market sentiment. They seek companies whose intrinsic value, the true worth of their assets and earning power, is currently underestimated by the broader market. This often means identifying businesses that are temporarily out of favor, perhaps due to temporary setbacks or misperceptions, but possess strong fundamentals and a clear path to recovery and future growth. It is about recognizing the forest, even when some trees appear to be struggling. This approach requires patience. Building wealth through ownership is not a race. It is a marathon. It involves allowing the power of compounding to work its magic over time, as reinvested earnings and growing profits contribute to an ever-increasing stake in successful enterprises. The temporary setbacks that might cause a speculator to panic become opportunities for the owner-investor to acquire more shares at attractive prices, further solidifying their position in a business they understand and believe in. Furthermore, an ownership mentality encourages a deeper understanding of the companies in which one invests. Instead of relying on superficial analysis or speculative rumors, the owner-investor dedicates time to learning about the business. They might read annual reports, follow industry news, and even consider visiting company facilities if possible. This immersion fosters a more informed decision-making process and a greater conviction in their investment choices. This perspective also instills a sense of discipline. It helps to resist the allure of speculative bubbles and the temptation to chase quick gains. The owner-investor understands that true wealth is built on solid foundations, through the steady growth of well-managed businesses. This disciplined approach, combined with patience and a deep understanding of value, is the cornerstone of long-term investment success. It is about becoming a partner in prosperity, not merely a gambler in the market. The focus shifts from the ephemeral nature of stock prices to the enduring reality of business performance. This is the essence of the ownership mentality, a philosophy that rewards understanding, patience, and a genuine belief in the power of well-chosen businesses to generate wealth over time. The journey of value investing extends far beyond the immediate financial statements. It delves into the very heart of a business, seeking to understand not just its present worth, but its enduring potential. This involves a careful assessment of the long-term prospects, a crucial element for building investments that stand the test of time. Consider the businesses that have weathered economic storms and emerged stronger. Their resilience is often rooted in a fundamental understanding of their future. This means looking beyond the next quarter's earnings report and contemplating the trajectory of the industry, the competitive landscape, and the company's ability to adapt and innovate. A strong future outlook is not merely an optimistic projection. It is a carefully reasoned conclusion, supported by evidence of sustainable competitive advantages. This perspective demands patience. Value investors are not seeking quick wins or speculative booms. Instead, they are cultivating a garden of assets, allowing them to mature and flourish over years, even decades. This requires a deep dive into the qualitative aspects of a business. What is the quality of its management? Do they possess a clear vision and the integrity to execute it? Is there a culture of innovation and a commitment to customer satisfaction that will ensure continued relevance in an ever-changing world? The sustainability of a business is paramount. This encompasses not only its financial health, but also its ethical practices and its impact on the wider community. Companies that prioritize environmental responsibility, fair labor practices, and strong corporate governance are often better positioned for long-term success. These are not simply altruistic considerations. They are increasingly becoming drivers of consumer loyalty, regulatory approval, and investor confidence. Assessing future prospects involves a thorough analysis of market trends. Is the demand for the company's products or services likely to grow or shrink? Are there disruptive technologies on the horizon that could render its offerings obsolete? Identifying businesses that operate in expanding markets or possess the agility to pivot into new areas is a key strategy. This foresight allows for investments that are not just undervalued today, but are poised for significant appreciation tomorrow. Furthermore, the concept of a moat, a term popularized by Warren Buffett, becomes essential. This refers to the durable competitive advantages that protect a business from rivals. It could be a strong brand, proprietary technology, network effects, or significant switching costs for customers. A business with a wide and deep moat is more likely to maintain its profitability and market share over the long haul, providing a stable foundation for enduring value. The process of understanding a business's future is an intellectual pursuit, one that rewards curiosity and diligent research. It involves piecing together a narrative of growth, innovation, and resilience. It means identifying companies that are not just surviving but thriving, and whose future potential appears to far outweigh their current market valuation. This long-term focus allows for a more tranquil approach to investing. Market fluctuations, while present, become less of a concern when the underlying value of the investment is expected to grow steadily over time. The emphasis shifts from reacting to daily news cycles to understanding the fundamental drivers of a business's prosperity. It is about owning a piece of a well-managed, sustainable enterprise with a bright future and allowing that future to unfold. This patient accumulation of enduring value forms the bedrock of a truly successful and peaceful investment strategy. The market, a vast and complex arena, does not always immediately grasp the intrinsic worth of a truly exceptional enterprise. There are times when even companies demonstrating robust fundamentals, sustainable competitive advantages, and clear pathways to future profitability may find themselves trading at valuations that do not reflect their true substance. This can be a period of quiet observation, a testament to the sometimes slow diffusion of information and sentiment within the financial world. It is during these phases that the discipline of value investing is truly tested. The investor, having diligently conducted their research and identified a business with a solid foundation and a promising outlook, must cultivate a deep well of patience. The temptation to react to short-term market fluctuations, to the prevailing winds of sentiment, can be strong. However, the core tenet of this approach is to look beyond the immediate noise and focus on the enduring value of the underlying business. Consider the analogy of a rare gem, unearthed, but not yet fully appreciated. Its inherent beauty and rarity are undeniable to the discerning eye, yet the broader market may take time to recognize its true brilliance and assign it a commensurate price. Similarly, a company may be operating efficiently, innovating effectively, and generating consistent returns, yet its stock price may languish, seemingly disconnected from its operational success. This disconnect is not necessarily a sign of flawed analysis. Rather, it can be an opportunity. It is during these periods of market indifference that the patient investor can accumulate shares at attractive prices, effectively buying a piece of a valuable enterprise at a discount to its intrinsic worth. The underlying business continues its work, building value day by day, while the market's perception slowly catches up. The role of the investor in such circumstances is not to attempt to predict the exact moment of market recognition, a task fraught with uncertainty. Instead, the focus remains on the fundamental quality of the business. Is it still operating with integrity? Are its competitive advantages intact? Is its management team sound? If the answers to these questions remain affirmative, then the patient holding of these investments becomes a strategic imperative. This requires a certain fortitude, a willingness to stand apart from the crowd when popular opinion may be leaning in a different direction. It means trusting in the rigorous analysis that led to the initial investment decision and having faith in the long-term trajectory of the business. The market, in its own time, often corrects these misalignments. The forces of supply and demand, driven by a deeper understanding of a company's true worth, eventually tend to push the stock price towards its fair valuation. Therefore, the strategy is not one of passive waiting, but of active conviction. It is a period of holding with purpose, knowing that the underlying value is being created, and that the market's eventual recognition is a probable, rather than uncertain, outcome. It is about building a portfolio of businesses that are fundamentally sound, and then allowing the compounding power of their earnings and the eventual reevaluation by the market to work their magic over time. This can be a quiet, yet profoundly rewarding journey for the disciplined investor. The principle of compounding is a quiet force, often underestimated in its transformative potential. It is not a sudden surge, but a gentle, persistent growth that accumulates over time. Imagine a small seed, planted in fertile ground. Initially, its progress is almost imperceptible. Yet, with each passing season, it draws nourishment, grows stronger, and its roots delve deeper. Compounding operates on a similar, elegant logic within the realm of finance. It is the process by which an investment's earnings, whether interest or dividends, are reinvested. This reinvestment, in turn, generates its own earnings, creating a snowball effect. The gains begin to earn gains, and this cycle repeats, accelerating the growth of the initial capital. The true magic of compounding, however, is not revealed in the short term. Its power is best appreciated over extended horizons, across years and even decades. In the early stages, the impact may seem modest. A small amount reinvested might appear to make little difference. But patience is the key ingredient. As time unfolds, the cumulative effect of these reinvested earnings becomes increasingly significant. Consider a modest sum invested with a consistent rate of return. In the first year, the earnings are calculated on the principal amount. In the second year, the earnings are calculated on the principal plus the earnings from the first year. This seemingly small addition compounds over time, leading to a dramatically larger sum than if the earnings had been withdrawn. Each reinvested gain becomes a new foundation upon which future gains are built. This creates a powerful upward trajectory for wealth. It is a testament to the idea that consistent, disciplined action, when sustained over long periods, can yield extraordinary results. The power lies not in dramatic, speculative plays, but in the steady, predictable growth that compounding affords. It is a journey that rewards perseverance and a clear understanding of the long-term perspective. In the context of value investing, the principle of compounding is fundamental. By identifying undervalued companies and holding them for the long term, investors allow not only for the appreciation of the stock price, but also for the reinvestment of dividends. These dividends, when put back to work, contribute to the compounding growth of the investment. Over time, this can lead to a substantial increase in the initial capital, far exceeding what might have been achieved through simple, sporadic investments. The wisdom of figures like Benjamin Graham and Warren Buffett consistently emphasizes this long-term approach. They understood that true wealth creation is a marathon, not a sprint. It requires discipline, patience, and a belief in the enduring strength of well-chosen assets. Compounding is the engine that drives this long-term growth, transforming modest beginnings into significant fortunes. This slow but steady magic of compounding is a powerful reminder that time is perhaps the most valuable asset an investor possesses. It is the fertile ground upon which the seeds of investment can grow and flourish. By understanding and embracing this principle, one can embark on a journey of wealth creation that is both sustainable and profoundly rewarding. The consistent reinvestment of gains, coupled with the passage of time, creates a virtuous cycle of growth, a testament to the quiet, yet immense, power of compounding. It is a principle that underscores the importance of patience and foresight in the pursuit of financial well-being. The principles of value investing, often discussed in the context of financial markets, offer a profound philosophy that extends far beyond the stock exchange. It is a way of thinking, a lens through which to view the world, encouraging thoughtful decision-making, and a deep appreciation for resourcefulness. This approach, championed by pioneers like Benjamin Graham and refined by investors such as Warren Buffett, is rooted in a fundamental understanding of intrinsic worth and a patient, long-term perspective. At its core, value investing is about identifying what is truly valuable, even when the prevailing sentiment suggests otherwise. It involves looking beneath the surface, beyond the immediate fluctuations of public opinion or market noise, to ascertain the underlying strength and potential of an asset. This requires a disciplined mind, one that is not swayed by fads or the allure of quick gains. Instead, it seeks out opportunities that are presently undervalued, possessing a solid foundation that promises future growth and stability. This philosophy of prudence can be applied to numerous aspects of life. Consider the acquisition of knowledge. Rather than chasing every trending subject or superficial piece of information, a value-oriented approach would focus on building a deep and robust understanding of foundational principles. It is about investing time and effort into subjects that offer enduring wisdom and practical application, rather than fleeting curiosities. The pursuit of knowledge becomes an act of building a rich internal portfolio, one that appreciates over time and provides a reliable source of insight. Similarly, in personal relationships, a philosophy of prudence encourages investing in connections that offer genuine support, shared values, and mutual respect. It is about nurturing bonds that are built on honesty and understanding, rather than superficial pleasantries. Like a well-chosen stock, a strong relationship provides a sense of security and belonging, a valuable asset that enriches life immeasurably. The effort invested in cultivating these relationships yields dividends of trust and companionship, a return far more significant than any material gain. Resourcefulness, a key tenet of value investing, also translates directly into daily living. Instead of impulsively acquiring new possessions to solve problems, a prudent individual seeks to make the most of what is already available. This might involve repairing an item instead of replacing it, repurposing materials for new uses, or finding creative solutions to challenges. This mindful approach to consumption not only conserves resources, but also fosters a sense of ingenuity and self-reliance. It is about understanding the inherent value in existing things and finding innovative ways to unlock their potential. The concept of patience, indispensable in value investing, is equally vital in personal growth and achievement. Significant accomplishments rarely materialize overnight. They are the result of consistent effort, strategic planning, and the ability to weather inevitable setbacks. A prudent individual recognizes that meaningful progress often requires time. They are willing to wait for the right opportunities, to let their efforts mature, and to allow situations to unfold naturally. This patient demeanor prevents hasty decisions that can lead to regret, and instead cultivates a steady, purposeful trajectory. In essence, a philosophy of prudence, inspired by the principles of value investing, is about cultivating a mindful and deliberate approach to life. It is about understanding that true value often lies in the enduring, the fundamental, and the well-considered. It encourages a shift from a mindset of immediate gratification to one of long-term appreciation, fostering a sense of security, resourcefulness, and a deep, abiding calm. This approach reminds one that the most rewarding investments are not always the most obvious, but those that are carefully chosen, patiently nurtured, and deeply understood. The pursuit of financial security is a journey often fraught with uncertainty. Yet, a steadfast adherence to proven principles can illuminate a path towards a more tranquil future, one grounded not in fleeting speculation, but in enduring value. This approach, deeply rooted in the wisdom of Benjamin Graham and refined by Warren Buffett, offers a stark contrast to the often chaotic realm of market timing and trend chasing. It begins with a fundamental shift in perspective. Instead of viewing stocks as mere tickets to be traded, value investing sees them as ownership stakes in real businesses. The goal is not to predict the next market movement, but to identify companies whose intrinsic worth far exceeds their current market price. This requires a patient, analytical mind, willing to delve beyond the surface noise and understand the underlying economics of a business. Imagine a quiet antique shop, filled with treasures waiting to be discovered. Value investors are akin to discerning collectors, meticulously examining each item, assessing its quality, its history, and its true potential. They look for companies with strong balance sheets, consistent earnings, a history of profitability, and a durable competitive advantage, what Warren Buffett famously calls an economic moat. This moat protects the business from competitors, allowing it to thrive and generate profits over the long term. The process of identifying such opportunities involves diligent research. It means understanding a company's products or services, its management team, its industry landscape, and its financial statements. It's about asking critical questions. Is this a business I understand? Does it have a sustainable edge? Is it being sold at a discount to its true value? This is not a quest for get-rich-quick schemes, but a deliberate, thoughtful selection of quality assets. Once a company is identified as undervalued, the next crucial step is patience. The market, in its often irrational exuberance or despair, may take time to recognize the true worth of a solid business. Value investors understand this. They are content to hold their investments for extended periods, allowing the underlying value to appreciate and compound. This is where the true peace of mind emerges. The daily fluctuations of the stock market lose their power to induce anxiety. The focus shifts from short-term gains to the steady, reliable growth of a well-chosen enterprise. This long-term perspective fosters a sense of security that speculative trading can rarely provide. When one invests in a fundamentally sound business at a significant discount, the downside risk is inherently reduced. The margin of safety, a cornerstone of Graham's philosophy, acts as a buffer against unforeseen events. It's the difference between buying a dollar for 50 cents. Even if the market continues to be volatile, the underlying value of the business remains, and the investor is well positioned to benefit as that value is eventually recognized. Building a secure future through value investing is not about eliminating risk entirely, but about managing it intelligently. It's about understanding that volatility is a natural part of market cycles, and that by focusing on intrinsic value and maintaining a long-term outlook, one can navigate these cycles with a greater degree of confidence and serenity. This disciplined approach cultivates a financial landscape built on solid foundations, offering a peaceful escape from the storms of market speculation and paving the way for a future of enduring financial well-being. Value investing is a philosophy built upon a foundation of clearly defined principles. These core tenets, when understood and consistently applied, create a framework for making sound investment decisions, fostering a sense of calm and control in the often turbulent financial markets. At the heart of value investing lies the concept of intrinsic value. This is the true worth of a business, determined by its underlying assets, earnings power, and future prospects, independent of its current market price. It's akin to understanding the inherent quality of a diamond, separate from the fluctuations of the jewelry market. Identifying this intrinsic value requires diligent research, a deep dive into a company's financials, its competitive landscape, and its management's capabilities. It's a process of uncovering hidden worth, a patient pursuit of understanding a business's true economic engine. Hand in hand with intrinsic value is the principle of the margin of safety. This is the buffer, the protective cushion between the intrinsic value of a stock and its market price. Buying a stock at a significant discount to its perceived worth provides a margin of safety. This discount acts as a defense against unforeseen events, analytical errors, or simply the inherent unpredictability of the market. It's the assurance that even if estimations are slightly off, or if external factors create temporary headwinds, the investment is still likely to be sound. A wider margin of safety offers greater peace of mind, allowing investments to weather storms with greater resilience. The third pillar is a long-term perspective. Value investing is not about quick gains or speculative trading. It is about owning pieces of sound businesses for extended periods, allowing their intrinsic value to grow and be recognized by the market over time. This patient approach recognizes that the market can be irrational in the short term, but tends to be rational in the long run. By holding investments through market cycles, investors benefit from compounding returns and avoid the costly mistakes often associated with trying to time the market. It's about cultivating a garden, not chasing fleeting rainbows. Finally, and perhaps most crucially, is the discipline of emotional control. The market is a constant barrage of news, opinions, and price movements, all designed to elicit emotional responses. Fear and greed are powerful forces that can lead investors astray, prompting impulsive decisions at precisely the wrong moments. Value investors strive to remain detached from the daily noise, making decisions based on fundamental analysis and their long-term plan, rather than succumbing to herd mentality or panic. This emotional discipline is the bedrock upon which all other principles are built, allowing for the consistent application of value investing strategies even when faced with market volatility. It is the quiet strength that separates enduring investors from those who are swept away by the tides of speculation. These four tenets, intrinsic value, margin of safety, a long-term perspective, and emotional discipline, are not merely abstract concepts. They are practical tools that, when honed through practice and patience, empower investors to navigate the financial landscape with confidence and serenity. They form the quiet foundational strength of an investment approach designed for enduring success and peace of mind. Value investing, at its core, is an invitation to embrace a journey. It is a path less traveled, one that rewards patience, thoughtfulness, and a deep understanding of intrinsic worth. This approach to building wealth is not about frantic trading or chasing fleeting trends. Instead, it is a deliberate and measured process, akin to tending a garden, where consistent care and a long-term perspective yield abundant harvests. The principles championed by Benjamin Graham and refined by Warren Buffett offer a framework for this serene pursuit. They teach us to look beyond the daily fluctuations of the stock market, to peer beneath the surface of headlines and speculation, and to seek out businesses with enduring quality and inherent value. This requires a disciplined mind, one capable of resisting the siren song of herd mentality and instead focusing on the fundamental strengths of a company. Identifying an undervalued company is not a matter of chance, but of diligent research. It involves understanding a business's financial health, its competitive advantages, its management team, and its long-term prospects. It is about recognizing a sturdy oak tree when others are captivated by the ephemeral beauty of a wilting flower. This deep dive into the mechanics of a business fosters a profound connection with one's investments, transforming abstract numbers into tangible entities with real-world impact. Once such a company is identified, the true essence of value investing unfolds: patience. The market, in its often irrational exuberance or unwarranted pessimism, may not immediately recognize the true worth of a well-chosen stock. This is where the investor's conviction is tested. It is during these periods of market indifference or temporary decline that the patient value investor finds opportunity, acquiring shares at a discount to their intrinsic value, confident that time and sound business fundamentals will eventually lead to a revaluation. This long-term perspective cultivates a sense of tranquility. The daily noise of financial news loses its power to disturb. Instead, there is a quiet confidence born from the knowledge that one is invested in businesses that are fundamentally sound, capable of weathering economic storms and emerging stronger. This is not to say that challenges do not arise. Market downturns are inevitable, and individual companies can face setbacks. However, a robust understanding of a business's underlying value provides a crucial anchor, allowing for rational decision-making even in turbulent times. The process of building a value-oriented portfolio is a testament to the power of compounding. By consistently reinvesting earnings and allowing the inherent growth of quality businesses to work their magic, wealth is built not through aggressive speculation, but through steady organic expansion. This gradual accumulation of assets fosters a sense of security and peace, a stark contrast to the anxiety often associated with more volatile investment strategies. Embracing the journey of value investing is, in many ways, embracing a philosophy of life. It is about understanding that true value is often hidden, requiring effort and dedication to uncover. It is about recognizing that patience is not merely a virtue, but a powerful tool for achieving long-term success. And it is about finding a quiet confidence in the enduring strength of well-chosen enterprises, allowing for a more peaceful and fulfilling approach to wealth creation. This knowledge, when internalized, can bring a profound sense of comfort and unwavering confidence to the pursuit of financial well-being.